which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft of the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
yourself to expose everything you won't admit.
And action.
This entire video is based on a true story. When I do like motivational speeches or even tell myself like, love yourself and you should love yourself.
This is Lily Singh. But to fans all over the world, she's the YouTube star Superwoman.
What up, everyone? It's your girl, Superwoman.
I know we can change the world for the better, one positive day at a time.
My parents now know what I do. They didn't know what I did for a long time in the beginning of my career. I was just making videos in my room. They had no idea.
Mom, Dad, have you seen my keys? I can't find them anywhere. Because you're always on phone.
Until someone called them, like a family member from another part of Canada, was like,
Canada.
Is your daughter making videos? And my mom was like, I don't know, Lily, are you making videos?
Just making videos grew into an entire career. Today, Lily's YouTube channel has some 12 million subscribers, over 2 billion views, and guest stars like Michelle Obama, Dwayne "The Rock" Johnson, and Seth Rogen.
I think a lot of young girls are raised to believe that you're going to go to school and then graduate and then get married and then get a job and then have kids.
And Lily was on that path, all the way through a psychology degree at York University in Toronto. But when she started thinking about a career,
I started to immensely panic and think something was wrong with me because I tried to figure out my life and it wasn't working in that straight line.
It was 2010, and YouTube was only 5 years old.
I thought nothing of YouTube. I was probably the last person in my circle of friends to discover YouTube. And I remember when I did, I thought, this is so strange. There's people making videos in their rooms and other people are watching them.
So she figured, why not give it a shot?
I one day posted a video because I was sad and I wanted to be creative and happy.
She didn't know how to edit video or write scripts, so she winged it.
It was so bad and so cringe. And my expectation was literally nothing. I was like, I'm gonna put this video up, a couple of my friends are gonna watch it, probably make fun of me, and that's gonna be the end of this. The second and third video came from, wait, 70 people watched my first one, can I get 80 to watch the next one?
She kept creating, she kept posting, and the viewers kept coming. Lily had found an audience.
A lot of the comments were, oh my God, there's a brown girl on YouTube.
More specifically, Indian. Lily's parents immigrated to Canada from India, and Lily was born and raised in Scarborough, near Toronto.
My home life was awesome. My parents, even though I portrayed them to be quite strict in my videos.
Oi, Lily, where the rest of your skirt, huh? I teach you like this to walk around like this, showing everything to everyone?
They actually aren't like that at all. They're pretty modern and pretty cool.
Your dress is short. Don't know what for.
And were pretty lenient with me. I mean, I got away with a lot of things. I was a brat. I was a brat.
She had a different idea of what she wanted out of life than other kids. In a grade school graduation slideshow, her classmates said they wanted to be lawyers and doctors.
And then I came up and I was like, rapper.
Making out with your friends, man. But then you say that you hate hoes.
I could just feel my parents being like, why?
Because that's just not something women really did in the Singh family.
I know there was a ton of people that weren't happy about my birth being a female, so I think, and that's some real-ish, but it's a real thing. The best thing I could have done to prove to so many people that didn't want my mom to have a daughter was to become Superwoman.
What up, everyone? It's your girl, Superwoman.
It was the name of Lily's favorite hip-hop song by Lil Mo featuring Fabulous.
I love the song so much because it was one of the only songs at the time that was an empowering female song, where Lil Mo's going on about, like, I will save guys with my superpowers, and I will save girls with my superpowers, and I am the Superwoman. I thought, this name that I've had for so long that empowered me when I was younger, I'm gonna make this my screen name.
Maybe there should be a new series.
Superwoman didn't just burst onto the scene overnight with a viral video. It was a steady climb fueled by hard work.
The moment that I thought this is going somewhere and this could be a career was the first time I performed internationally. It was in India. And it was the first time where I was truly across the world and people knew my videos.
Singh has transformed herself from a bratty kid to an internet personality to a media mogul. She starred in a feature film, A Trip to Unicorn Island, in 2016. And her book, How to Be a Boss, hit the New York Times bestseller list in 2017 while she was on a 30-city international tour. Lily started out with the goal of getting millions of subscribers and financial security.
Hurry the hell up.
But after surpassing those goals, success has new meaning.
I've really come to terms with the fact that my definition of success is what's the best legacy I can leave behind. And it's not the number of views, the number of subscribers. It is the number of people that can say, this girl changed my life or changed something in my life positively.
CTE is often found in the brains of deceased athletes, military veterans, and others with a history of repetitive brain trauma. Hundreds have donated their brains to the VA Boston University Concussion Legacy Foundation Brain Bank.
This is a former NFL player who died in his early 70s, and this is a veteran who also died in his early 70s.
Dr. Ann McKee dissects these brains.
The hippocampus and the mammillary bodies are very important for memory. I can see that they're slightly affected.
McKee recently dissected the brain of former New England Patriots player Aaron Hernandez, who was convicted of murder and later committed suicide.
You'll see right away that the brain is showing signs of shrinkage. You can see the crevices in the brain that you can't see in the normal.
McKee says Hernandez's severe case of CTE impacted his decision-making, depression, and ability to control rage and aggression. Right now, she thinks we're underestimating how many people have CTE.
We were able to distinguish between CTE and controls and CTE and Alzheimer's disease. The next question is, can we do this in the blood, and can we do this in living people? And we aren't there yet with those answers.
But the need for a diagnosis in the living is motivating companies such as Quanterix in Lexington, Massachusetts, to work faster on technology that could diagnose concussions and CTE in as few as 30 minutes. Kevin Rosovsky is the CEO.
It's like a high-powered microscope. And so by doing that, we can see little biomarkers that you couldn't see before in the blood.
Quanterix received a grant from the NFL and just went public. Since then, its stock is up more than 40%. The company sells a machine called Simoa for $175,000 to other biotechs, hospitals, and researchers.
And for the first time in history, we're able to see brain health in blood, and that's a major breakthrough, and that's leading to less invasive testing, and we've already been able to see evidence of concussions, and there's the beginning evidence of being able to see the accumulated effect of concussions.
Quanterix is also trying to detect Alzheimer's disease, multiple sclerosis, and ALS. Rosovsky says he thinks diagnosing concussions will be easier than diagnosing CTE.
Diagnosing CT in the living probably is a couple years away. We're real excited to see the progress, but reducing some of that work into actual tests in a laboratory takes time. There's regulatory approvals. There's a lot of red tape that you have to go through.
Also in this race to diagnose CTE in the blood are Athlon Medical and Exosome Sciences. And New York's Mount Sinai Hospital is scanning for the disease in the living. But it's just one step in a series of questions for those with serious head trauma. There's still no cure for CTE.
Even if we had a great idea for a treatment, there's no way to test whether it's effective or not. So that's the enormous advance that we'll get if we can develop a biomarker for this disease.
In Boston, Ann Mostu, Bloomberg News.
Wine is a $300 billion global industry where one person's opinion can make fortunes or break them. That's because of this man, Robert Parker, and his newsletter, The Wine Advocate. For 3 decades, he dominated as the world's most influential wine critic. Now Parker's protege is building an empire of his own. Antonio Galloni runs Venice.
Antonio, tell me, what are you trying to build at Venice?
Well, at Venice, we started with the idea in 2013 of building a world-class platform. We have a database of about 250,000 professionally written reviews. On Delectable, we have 7 million user reviews. Through Delectable, we also have a partnership with Whole Foods and several other partnerships that we can't announce just yet. And when you put that all together, what we have is something that no other company in our space can even come close to.
Do you think of yourself as the next Parker?
Not at all.
Why?
Because Steve Jobs said you can't live your life trying to be somebody else. So he's one of my biggest influences, and I've never wanted to be a replica of somebody else because a replica is never as good as the original. Bob is a genius, fantastic, one of a kind. We're going to be something completely different, and I have no desire to be some version of somebody else.
Different in what way?
Every decision that I've made at this company is completely anathemic to what Bob did with his company. I want our writers to be partners. All of my senior people are locked into the company. They all have equity or they have a path to equity based on business results. That's something that we never had at Parker. Our benefits are world-class, and everything that we've done at Venice is completely different from that model. When Steve Tanzer, who is the most experienced active wine critic in America, wants to work with us, that says something. When Alessandro Masnaghetti, who's the best cartographer of vineyards, wants to work with us, that says something. When Neil Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that 1 or 2 people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it's like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have 2 guys who are ahead of that and 1 knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left The Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company. And that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
In the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! That's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette.
I'm a writer for Bloomberg News for the global business team.
And Kim Basine.
And I'm the U.S. luxury reporter at Bloomberg.
To find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW,
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
With violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music. And their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook Facebook or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what there used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big.
Traders, okay, we need to move further our stop on profit for Swiss franc, and I'm going to move to 0.91921. Just right here, okay? It will give us 1,000 pounds in profit. Okay, it's a good day today to trade Swiss franc. All of you guys, please stay with me and please move your stop on profit. I'll speak to you later.
Around 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It is governments that have the legal authority to create large marine reserves in the ocean, but also local communities. We are not talking about something that is apart from us. We are not apart from nature. We are a part of nature. So these 10 years are probably the most critical in the history of humanity.
The most accurate measurements of changing oceans will come from space. While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission, track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
one of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast, and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions, an equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at a regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube size concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, E-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everyone. It is Monday. It feels like a Monday, man.
Happy Monday, Carol.
Yeah, right. Let's just get to Friday.
Okay, let's do it.
That's how I feel already. What worries? We've got a rally underway. Stocks back with a vengeance, climbing and led by companies tied to the economic reopening. Where else can you find returns, especially in a low-rate environment? That's all I'm going to say.
Hey, that's the question. Speaking of returns in a low-rate environment, lots of Fed speakers this week, including Fed Chair Jerome Powell. Bitcoin, though, Carol, kind of a drag.
Yeah, a bit of a bummer.
And no Elon Musk tweet involved this time.
What's going on? Father's Day, he must have been busy. We're going to talk about all of that. We're also going to talk about Amazon Prime Day, and then there's the age of scrutiny. Get ready for the next major deception in financial markets. Dun, dun, dun.
All that and more coming up in the next 3 hours. In the meantime, let's get a check of the trading day with Doug Krisner. Hey, Doug.
Hey, Tim. Hi, Carol. The reopening trade very much in high gear today. We had St. Louis Fed Bank President Jim Bullard saying earlier, the American economy is booming and it's on a path to recover more than it lost during the pandemic. So it really shouldn't be a surprise that long-term interest rates are higher today. Now, on top of the Bullard commentary, we heard from Dallas Fed Bank President Rob Kaplan today. He favors beginning the process of tapering asset purchases sooner rather than later. We've got a 10-year Treasury now yielding 148, so we're higher by more than 4 basis points on the New York session. Right now, Dow Industrial Average ahead 1.8%. In the broader market, we have energy, industrial, and financial shares leading the S&P higher by 1.4%. NASDAQ Composite, meantime, better by about 0.9%. You mentioned Bitcoin. Overnight, Beijing ordering the payment platform Alipay and some domestic banks in China not to provide services linked to trading in any way of a virtual currency. So Bitcoin right now off about 9.5%, 32,415. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Dougie, thank you so much. You're listening to Bloomberg Business Week. Carol Master, along with Tim Stenovic in our Interactive Broker studio. In case you forgot, it is Monday, June 21st. Whew, where did June go?
Where did it go? It's like we're almost halfway through the year. Second quarter wraps up in just a few days.
I'm like my head
4th of
spinning.
July is happening. What's going on here?
I don't know. And we got to find out what's going on with the markets. Let's get to the Market Drivers Report. And let's bring in our team. With us is Kriti Gupta. She is Markets Live reporter at Bloomberg News, right next to me in our Interactive Broker studio. Mike McClone, we've shuttered him to the isolation booth. He's our commodity strategist at Bloomberg Intelligence. No,
Nothing
we're just
personal,
We're still
Mike.
doing a little bit of social distancing in our studio.
We should explain. He came in. We were really excited for all four of us to be together in the Bloomberg Interactive Broker studio. And then we had to tell Mike to leave because we're still
we
three-person
didn't.
max.
Reggie, the producer, was
Yeah,
like,
that's
Mike,
true.
you got to leave.
Oh,
Reggie's
wow,
the worst.
throwing
I
Reggie
know,
under the
God,
bus.
Reggie, under the bus. Kriti, let's start with you. It's a rally. It's like we heard the Fed. We're buying into inflation transitory. We're going to be okay. Keep in mind, rate increases still a couple of years away.
Absolutely. I mean, the breadth of this rally is really pretty substantial. I think it's the biggest breadth in terms of breadth since April of 2020. That's over a year. That's a very broad rally. It means if you're a tech investor, if you're a small cap investor, if you're doing the boring stuff and doing REITs and utilities, you are having a very good day in the markets today. And that's not, I think a lot of it is going to just be simply a function of last week. We had a 2% loss. It was the worst weekly loss in, I think, a few months. I think since February. And so I feel like people are buying the dip. Well, there's also some...
Well, what's the difference? I just cut you off. But like, what's the difference between last week and this week, Kriti? Sorry for cutting you off.
Well, I mean,
you were just getting to that.
I was.
Should I let you talk?
You should. I mean, we'll just look at the colors on your screen, right? It's a lot of.
He had chocolate-covered coffee beans.
I had
This is
like
what
9 of them
happens. This is
before
what
the
happens
show.
to Tim. Anyway, go ahead.
And you didn't
Kriti.
get me any. The worst.
Tomorrow I'll bring it for you.
Go ahead.
Yeah, absolutely. I mean, so listen, we have a ton of Fed speak right now. So this is a classic buy the dip moment. You are seeing the trade that I think wasn't working last week, really working this week. It's kind of flipped on its head. So last week, the trade was sell your cyclicals, go defensive. Today, it's the exact opposite. Risk on, not just in the stock market. You're seeing it in the bond market as well. Yields are higher, futures are higher, and sector by sector, everything.
All right, everything
great.
but Bitcoin.
Everything but Bitcoin.
Mike McClone, come on in on this. Commodity strategist. I can feel your presence here. It's not the same, but take it away.
We miss you.
But hello. I think one key thing to note about the big rebound in the equity market is last Friday was the triple witch, and it broke down below that strike. So that just kicked in lots of stops. It's impressive it's coming back, along with bond yields. So I'm kind of encouraged to see that. I'm kind of surprised Bitcoin's this much lower.
Wait. Let's go back to equity markets, because you said it was going to be important this week that we see a rally, correct?
It is very important because we broke down through that 4,200 strike. It was significant on Friday, and what Kriti explained is it's like everything's just snapping right back. So hopefully it's just not short term, and hopefully it's just a little. Hopefully it is a short term little blip, and it comes right back. It was just related to too many expiration pieces having to get lifted out on Friday. But no, that's why you're seeing so much breadth, because it's right after the triple witch. But it's the key level of where it did it from. Remember, everything collapsed. Last night, I saw that 30-year drop to 1.94, and here it's 2.10.
Mm-hmm. Right.
So it's coming. Everything's reflating. It's coming back. And Bitcoin is part of the deflation, except it's staying down. But the way I see what's happening with Bitcoin is still range trade. Remember last week the high was 40,000. Now the support is around 30. It's still above that level. It's kind of trading in a range, getting near the lower end of the range. And I love when you see signals like this, like a death cross. When it's widely noted, it usually means the longer-term traders say, okay, thank you very much, I'll look and buy. And I think this is what it's going to do is attract buyers. I still see really good support around 30,000.
Okay, Mike, bring China into this, because Bitcoin falling to this 2-week low as China cracks down on crypto. Does Bitcoin have enough interest? Is it widespread enough to survive without China? To flourish without China?
I think it's a classic case, Tim, of short-term bearish, very bullish long-term. Because what's happening in China, yes, they're cracking down on miners. It's getting them away from coal. It's actually pushing it more towards North America. But it's a good indication of what's happening in this Cold War between the world of digitalization of assets. They're very free, open markets, and that doesn't play in China. They don't want their citizens to have free access to capital from different parts of the world, and Bitcoin just allows freedom, and that's what's really working in North America, i.e. Canada has ETFs, Europe has ETFs, Switzerland definitely, but China cracking down to me means the U.S. is probably going to say, hey, we're winning this Cold War without trying. Sure, it might be short-term bad for the price, but bigger picture, I think it's better for the price, and people realize, wow, this is a place I can actually really save some value, and no one really has access to it. So China's going to try to crack down. The question is, how successful will they be on dislodging Bitcoin from clients, from their citizens?
Yeah, exactly. Hey, Critty, what are you watching out for the rest of the week, especially as these Fed speakers, including Jay Powell, get ready to make some comments?
So I have a very non-Critty answer, and it's I think I'm going to watch Bitcoin, and here's why.
Wow.
Because on a day that the stock market is doing really, really well and bond yields are coming out higher, Bitcoin is dropping. And of course, these are on fundamental reasons, so there is that kind of diversion. But remember, Bitcoin is a risk sentiment indicator. If Bitcoin's up, it means people are taking more risk. People are more kind of hopping into those riskier assets. And today, it's kind of the opposite, right? So I think I want to look at that dynamic, whether Bitcoin, that contagion, is still a thing, or if Bitcoin's kind of doing its own pattern.
Mike, saved you 20 seconds to respond to that.
I don't disagree. I think that's a good analogy. And today's one of those kind of confusing days. Bitcoin down, everything else up, even bond yields up, and crude oil up. So we'll see how. I think it's just mostly after Friday's washout, see how things pan out. It's the end of the week's going to matter. Hopefully we're going to recover. Hopefully yields will be able to go. Hopefully the stock market will be fine. I see Bitcoin holding support.
People went to the beach over the weekend. They were like, okay, maybe things aren't so bad. Okay, the Fed said we've got a few years,
Let's sell some
Bitcoin. The sun's shining, the birds are chirping. It's going to be fine.
It's like a Disney movie. That's how it is. All right, Kriti Gupta, thank you so much. Markets Live reporter at Bloomberg News. Mike McClone, love him, commodity strategist at Bloomberg Intelligence, even though we shunned him.
You're welcome here anytime, Mike.
He's
okay?
welcome always.
And soon we'll be able to get 4 people in the studio.
Exactly. Fingers crossed. Bite of the day?
It's one number that tells us a lot. It's brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. Learn more at GEP.com.
All right, Tim, today's number is 1,000. Amazon has placed an order for 1,000 autonomous driving systems from self-driving truck technology startup Plus. The e-commerce giant also in talks to buy a stake of as much as 20% of Plus. That's according to those familiar with the matter. The Sequoia Capital China-backed company is developing autonomous driving technology for long-haul trucking and is set to have a valuation of $3.3 billion. A company statement last month saying Plus added $500 million in proceeds to accelerate its expansion. The aspect I find so interesting to the story is just, how Amazon is reaching out, and they have to kind of have the infrastructure, the transportation requirements met in order to make sure they can keep on doing what they do.
Whether it's planes, whether it's trucks, whether it's autonomous vehicles, they need to get that last mile.
And automobiles.
You went there.
I did go there.
Let's get a check of world and national news with Nancy Lyons in D.C. Hey, Nance.
Hey there, Tim. President Biden is meeting this afternoon with lead financial regulators. He's looking for an update on the state of the nation's financial systems. The administration has been especially concerned about how regulatory agencies have been focused on confronting global warming. The SEC, Wall Street's principal regulator, is working on a new set of rules to force companies to make disclosures related to climate change. President Biden's infrastructure plan is entering a procedural phase in Congress that could take weeks to navigate. Bloomberg's Amy Morris reports from Washington.
If it goes according to the Democrats' plan, the Senate will pass a bipartisan infrastructure deal next month, along with a budget blueprint that could set up a vote later on a far larger bill. But it could be September before it's passed. Still, progressive Democrats say they won't back a bill that gives up concessions to Republicans without guarantees that their priorities will be considered in future bills. Republican Senator Lindsey Graham says a deal is there, but it's up to the president whether to pursue it. In Washington, I'm Amy Morris, Bloomberg Radio.
The U.S. Supreme Court is siding with student athletes in a case concerning greater compensation. The nation's highest court, in a unanimous ruling, rejected the NCAA's effort to limit educational benefits like computers and internships. Under current rules, students cannot be paid, and the scholarship money colleges can offer is capped at the cost of attending the school. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar along with Tim Stanovic on this Monday, June 21st, 2021. Carol,
It's Monday, Carol. We can do it again, okay? You're what is it? So great she's going to do it twice. I don't even know what the saying is.
All right, let's get to a couple of stories. One by our Ashrat Carmiel and one by our Joe Mysak. Both of them are must-reads always. Ashrat covers the Manhattan real estate market. And she's got a story that talks about luxury home buyers are on a shopping spree in Manhattan. They're largely avoiding co-ops. We know co-ops can be tricky to buy.
They can. They require a lot more disclosure from the person doing the buying. And then if you decide to move out and you want to rent it out, it can be difficult to do that, among many other things. The story gets into that. But let's talk numbers here, because 177 co-op apartments priced at $4 million or higher went into contract this year through June 16th. That's according to data from the brokerage Olshan Realty. That compares with 615 condo deals in that category during the same period. So we should explain co-ops versus condos here.
Well,
because for people, I didn't know what this was until I moved to New York City.
Right, I've never bought one in New York City.
Yeah, neither have I.
But it's basically if you go before the board of the building usually, right? And you actually own ownerships in the building. But people can say you're a celebrity, we don't want you, or your lifestyle, or there's a lot of things that they can reject you for.
Right. As is written in the piece, the governing boards of these corporations are responsible for ensuring their properties are fiscally sound and pleasantly livable. They set rules on everything from how much cash residents need to have in the bank to when they can go and renovate their kitchens and how much their dogs can actually weigh, Carol.
Scout weighs 28 pounds. But yeah, I mean, this is what's going. There's a great quote by the president of the brokerage that bears her name, Donna Olshan, and she says, they're not new. They're talking about co-ops. And in order to get in and out, you've got to deal with a co-op board. If they're spending millions of dollars, they want to be able to buy and sell freely. Not have that tied up by shadow government, which is essentially what they say.
Shadow government, yeah.
Right. Like if you own property, you want to be able to get in and out at free will, and that's not the case for co-ops.
Yeah. So condos really hot right now. Just in the last few seconds, Carol, I want to talk about dinner reservations, because Joe Myzak's article, dinner reservations at 5 and 9, are showing that New York is back.
Yeah, exactly. Listen, it's a great story. We'll put it out on Twitter, or you can go to Bloomberg.com and read more from Joe Myzak about dinner in New York.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
U.S. equity market is recovering from Friday's slump. It looks as though the reopening trade is in high gear. We have a move up in long-term interest rates. 10-year Treasury now yielding just under 1.48%. And it's financials along with energy and industrial shares that are leading the S&P to a gain of about 1.4% right now. So we have essentially recovered everything that we lost in the Friday session. The Dow, for its part, up 1.7%. The NASDAQ Composite ahead by just 0.8%. JP Morgan Chase's asset management unit is purchasing Campbell Global. Now, Campbell focuses on timberland, as in forest, and natural resources. It has about $5.3 billion in investments, and in making the move, it looks as though JP Morgan is betting on growth in the carbon offset market, or markets plural. We've got the dollar right now showing quite a bit of weakness with the Bloomberg Dollar Spot Index down about 0.4%. I'm Doug Prisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much. You're listening to Bloomberg Business Week. Carol Masser, along with Tim Stenovic, in our Interactive Brokers studio. Well, among our most read stories on the Bloomberg, one about the individual who for almost 3 decades quietly shuffled around one of the world's biggest fortunes, and he basically had a chief priority, and that is keeping his fabulously wealthy bosses out of the headlines.
It's Michael Larson, and Sophie Alexander, Anders Mellon, and Tom Maloney have a deep dive into what exactly is going on with the money manager. Sophie Alexander, a reporter for Bloomberg News, joins us on the phone from New York City. Sophie, great to have you back with us on the program. Take us into the big change, at least in terms of name, that we saw recently when it comes to the family office.
Yeah, just this morning, they changed the name for the umbrella organization, the parent organization, from Bill and Melinda Gates Investments to Cascade Asset Management Company. And so that's just the latest rebranding we've seen. The last time they changed the name was back in 2014 when they actually added Melinda's name. And before that, it was just Bill Gates Investments.
So tell us a little bit more about this individual and the office, because I think we know these people are wealthy. We know somebody's managing their money, yet we really didn't know a lot beyond Cascade Investments being the name of it.
Right, exactly. And that's exactly what they wanted. Their whole mandate.
Mission done.
Discreet. Exactly. And up until now, of course, when everyone's talking about it in light of not only the divorce, but the New York Times reporting about the work environment that Larson created. And Anders and I talked to some former employees who all asked to remain anonymous because there's a culture of NDAs at the company. But what we've heard is that, it's a very generic seeming office. Nothing that you see there would suggest that it's the money manager for one of the richest, or if not the richest person in the world at some points in the timeline. And, Larson kept things discreet, and that was his chief objective.
What about returns, though? I mean, the idea is to have wealth grow.
Right. I think that there's this thinking that, the richest people in the world can hire the best money managers, and so then they should probably be getting the greatest returns. But actually, in family offices more generally, there's sort of a culture of preserving wealth, not necessarily growing it. Bill Gates is worth more than $140 billion. It's not that he necessarily needs more money. And in fact, they're trying to give it all away. So, making more of that would be pretty difficult. It would make that goal pretty difficult to do. So what we found from people familiar and from some public records is that the returns since 2001, the average annual returns were about 8.5%, which beats the S&P by about 1 percentage point over that time.
Okay. And like you say, though, wealth preservation on a chunk of money is really, really important, especially for someone or individuals who are looking to give it away. What's interesting is, too, though, we nonetheless, Sophie, like to know kind of where they're doing it. And I thought that was kind of interesting. I was a little surprised about the amount of land that they own.
That's right. They are the largest individual private farmland owner in the U.S. They have about 270 acres of land.
270,000, right? 270,000 acres.
Oh, sorry.
That's
yes,
okay.
270,000 acres. That's an important distinction.
And tell us a little bit more about it. I mean, it's farmland specifically. What else do they do? I think there's currency, commodities. What else?
Yeah, there's some of the basics, and then they also have almost half of the Four Seasons hotel brand, which they bought up in 2007. And then a lot of their public companies are very, sort of companies that don't necessarily always make the headlines. They're not the, Microsoft counterparts like Amazon or Facebook or anything like that. In fact, they had a mandate to stay out of tech. So we're talking more like Deere & Co., the tractor company, Canadian National Railway, Republic Services, Inc., which is a garbage company. And so, as we say in the story, these are companies that are rooted in the physical world of making, moving, and selling goods and cleaning things up.
And you also know, which I find really interesting, that they're not necessarily connected to their charitable work, which a lot of it is focused on disease eradication around the world and also increasingly on climate change.
Right, exactly. So the investments they make aren't necessarily reflective of that. Ultimately, the goals are sort of different. They're trying to make more money, not a crazy amount more money, and the foundation's trying to give it away and, make the world a better place. But that's the other thing we heard from former employees is that, working for a company that was ultimately making money for the Gates Foundation, felt like a noble cause.
Well, and what's interesting, too, is we know one of their major issues has been certainly climate change, and yet there are investments in oil and gas companies, right?
Right. So Bill Gates said in his book that in 2019 he divested from those companies and that the foundation did the same. They still have some stocks and bonds in the foundation trust. And then what Cascade also does is it farms out some of the money to other money managers, and they don't necessarily have control over what they're investing. So there are some conflicts there, but Bill discusses it in his book.
Sophie, just got about 20, 25 seconds here. What was more interesting, learning about the man, Michael Larson, a little bit and finding out what you could, or about finding out about the Gates investments, just quickly?
I think, the investments were interesting, but I also think it's interesting to learn about the character who, has been in Bill's life for almost 3 decades, almost as long as he and Melinda were married. This guy has been around for a very long time.
Yeah, fascinating, some insight, right?
Yeah, and the big question is what happens next?
Yeah, it could be changes. And really, what does Melinda French Gates do with her money? Because she will become one of the wealthiest individuals in the world. Great stuff. Sophie, thank you so much. Sophie Alexander, reporter at Bloomberg News, on the phone in New York City. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so we talk a lot about social media companies, big tech in the spotlight. In fact, one of my decliners today, one of my gainers is Apple, despite being added to German, their watchdog's big tech hit list. There's an interesting story by our Sarah Fryer about someone who's looking to kind of reinvent the internet.
Yeah, Frank McCord, a billionaire real estate mogul, also former owner of the LA Dodgers, pouring $100 million into an attempt to rebuild the foundations of social media.
We'll get more of the story in just a moment, though. Back to your top business stories. A look at that trading day, that rally. Here is, including those big tech names. Here's Charlie Pellet.
It's Doug Krisner. That's
You're
all right.
right.
And yeah, tech has kind of taken a bit of a backseat today, but I'll talk more about the equity market in a moment, Carol. Let's begin with Bitcoin, because I'm seeing a big move lower here. We're down more than 9% right now. Overnight, Beijing ordered the Chinese payment platform Alipay, along with some domestic banks in China, not to provide services linked to the trading of virtual currencies. We're down, as I mentioned, nearly 10% right now, 32,530. That is the current price of Bitcoin. Carol was mentioning information tech. Yeah, there's an upside bias there, but I'm looking at a powerful rally in energy stocks. The S&P 500 energy group right now up more than 4%. This is coincidental with a move higher in the price of oil. WTI now up about 2.8%. We're at 73.65. Earlier, we heard from St. Louis Fed Bank President Jim Bullard. He was saying the American economy is booming and we are on a path to recover more than was lost in the pandemic. So the S&P 500 is up about 1.3%, the Dow ahead by more than 1.6%, and the NASDAQ comp rising about 0.8%. But we do have a move up in long-term interest rates. The financials are benefiting, so a lot of optimism on the reopening trade, pushing the yield on the 10-year up more than 4 basis points now. We're at 1.48%. I'm Doug Krisner. That's your Bloomberg Business Flash.
You are Doug Krisner.
I am.
And it's always nice
Last
to
time
have
we
you
checked.
here. I saw Charlie walking around doing some stuff, so I got a little confused. All right, so we said that the big social media companies are in the spotlight. We know that. Doug mentioned it. Tim and I talked about it. Have been for a while. Privacy concerns, big data concerns, a lot of things over the composition of their information on their websites. There is a billionaire real estate mogul who is looking to change that, in the process, basically save the internet.
Sarah Fryer is technology reporter for Bloomberg News. She's also the author of No Filter, the inside story of Instagram. She joins us now on the phone from San Francisco. Sarah, it is always great to have you on the show, particularly, though, when you have a story such as this that calls into question perhaps the way that people are thinking about investments to, well, change social media. It's not necessarily creating a different company, though, to go after Facebook and also the owner of Instagram, Facebook, right? It's the underlying technology. Take us into it.
Frank McCord told me that he has actually, he's a real estate mogul. He's been the owner of the Dodgers. He told me he's tried the other ways. He's tried investing in startups that he thought would be able to solve the problems of social media, perhaps create more useful alternative competitors that people will use that'll be healthier. But none of that has worked. And so he told me he realized he needed to do something that would be a combination of private sector and public sector. So he is building this, it's an open internet protocol that will keep track of people's social connections on the blockchain, so that if they are to use a separate social network, those connections can just be ported over. There's more consumer choice about where you go. And he thinks that that will solve the biggest problem with social media, which is that all of the power is concentrated in these big giants, especially Facebook. And those big giants have not been good stewards of that power.
Would it work? Would it make a difference? It would sound like a very different beast. And it would also require, billions of people kind of shifting.
It would require,
right?
It would require everyone to come on board and say, okay, yeah, let's try this for a while and see if it works. honestly, I think that's really hard. I think as much as people complain about social media, it's their habit. It's where all their photos and videos are. It's where their history is. And as you know, predatory or exploitative or troublesome as they think it might be, that's what they're used to, and it's really hard to change consumer habits. So not only does this need to be a solution to the problem of Facebook's power, you also need to have a solution that's appealing, that people, will want to use from a commercial perspective. And so starting September, McCourt says he's going to be investing in getting people to do that great migration, and that's really the hard part.
Where does Jack Dorsey, Twitter's founder and CEO, come into this?
Well, Jack Dorsey doesn't disagree. He thinks that, the idea of everything on the blockchain would remove some power from the big companies. He said after Twitter banned President Donald Trump, he was having these concerns about the fact that they had that power to do so. They thought, well, in this moment it makes sense. He's inciting violence. We have to take care of our users, but also we shouldn't have this much power to make these decisions. And if everything was permanent on the blockchain, undeletable, visible to all in the public, then we wouldn't be making these decisions. But of course, that means if you're not going to have content moderation, if everything's going to be public forever, well, those problems of extreme views and perhaps the worst of the internet, those will be undeletable too. So I think that there are definitely some trade-offs, and it may not be enough to say, well, because it's permanent, some people, Frank McCourt was telling me, because it is permanent, people won't want to say things that they'll regret later. I don't know that that's true. I think a lot of people make lots of money off of saying things that a lot of us would think are objectionable. So I think there are a lot of challenges ahead.
And it's relatively easy. It's, kind of frictionless in terms of moving around within it. And I do wonder about a new environment. Having said that, Sarah, I do feel like I remember having a conversation with the head of Mozilla, about how can we be better on the internet? Can we, now that we're how many years in, do something different and better? And so that we don't have bullying and misinformation. Just got about 25 seconds left here. There is momentum to kind of figure out a better way here, just quickly.
Well, there are 4 ways, right? There's the ways that the companies look inward and change their business model. There's the regulatory path where people make laws to make it better. There's the private sector, which is, startups get funded to do something different and people adopt it. And then the 4th way is this is kind of academic, experimental pursuit of an alternative. They're also slow, and the giants are getting gianter as we speak.
Exactly. They are indeed. Really interesting, and so glad we had some time with you. That is, of course, our own Sarah Fryer, technology reporter at Bloomberg News, author of No Filter, the inside story of Instagram from San Francisco.
Well, let's head to Washington, D.C. for a check of world and national news with Nancy Lyons. Hey, Nance.
Hey, Tim. The Supreme Court is allowing college athletes to receive some benefits. The High Court ruled 9-0 against the NCAA today in a case involving compensation. Loyola law professor Jessica Levinson says the justices agreed with the plaintiffs, who argued that the NCAA's restrictions on education-related benefits violated federal antitrust law.
The court says that the NCAA can't prohibit colleges from providing athletes paid internships, laptops, for instance. This doesn't totally chip away at the idea that college athletes are different from professional athletes, but it does get us part of the way there.
She says it is a victory for athletes. President Biden is still not buying into a draft bipartisan Senate infrastructure plan. A group of 21 senators, including moderate Democrats Joe Manchin and Kyrsten Sinema, are behind the draft proposal, but Bloomberg Government's Emily Wilkins says one big question remains: how to pay for it.
They've agreed to a top line number. They've agreed on spending, this bipartisan group of senators. But they've been talking about paying with this with a gas tax. And President Biden has said, absolutely not. We're not doing that. We're not doing fees on electric vehicles. The White House has put forward some other ideas on how to potentially pay for it. But that really needs to be agreed upon before either side can say, we're good on this one.
Aides say President Biden will host lawmakers this week to discuss the plans. The president met this afternoon with financial regulators to discuss issues like climate change and inclusion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Something Nancy touched upon, and we want to just dig a little bit deeper into it because it has huge implications. The U.S. Supreme Court clearing the way for greater compensation for student athletes in a ruling that may loosen the National Collegiate Athletic Association's grip over college sports. We're talking about the NCAA. We talked about this story last week. I believe it's in the magazine.
Yeah, with Bailey Lipschultz, who wrote about the new platforms that give college athletes a chance to make money off their likeness and image. Unanimously rejecting the NCAA's bid for a broad antitrust immunity, the High Court on Monday upheld an order that will let member schools provide more education-related benefits, including computers, internships, and academic achievement awards.
Yeah, the district order may, quote, encourage scholastic achievement and allow student athletes a measure of compensation more consistent with the value they bring back to their schools. Justice Neil Gorsuch writing for the court. The NCAA and its biggest conferences were battling against college football and basketball players who sued to let schools start paying athletes. The athletes got a partial victory when a federal judge in California said the NCAA didn't show it needed its limits on education-related compensation. When we talked about this story with Bailey last week, people were texting me and also sending me messages on the terminal and saying, wait a minute, they get a free education.
Okay.
Isn't that something?
Yet, I mean, look at how much coaches make. Look at how much the school makes, and look at how much professionals make who are as good as and they're close to being as good as those professionals. Gorsuch portrayed the case as a limited one, but Justice Brett Kavanaugh, this was trending on Twitter earlier today. He suggested that he would be willing to go much further in future cases, saying that the NCAA and its member colleges were suppressing the pay of student athletes who generate billions of dollars in revenue. Here's what he wrote, quote, nowhere else in America can businesses get away with agreeing not to pay their workers a fair market rate on the theory that their product is defined by not paying their workers a fair market rate.
Right, exactly. I don't know what the answer is because it does. Those, these college athletes bring in tons of money. We talk about these coaches making millions of dollars. These, it's become a business for these schools.
It's a huge business.
And kind of skews things differently, I think, for some of the other students who are there.
I think so, too. And also the public perception, the public idea of it has changed a lot in recent years.
Big deal. We're going to continue talking about this one, no doubt about it.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So the reopening trade is very much in high gear right now. The S&P 500 higher by about 1.3%. This advance is being paced by energy, financial, industrial, and real estate shares. Earlier today, St. Louis Fed Bank President Jim Bullard was saying the American economy is booming and it's on a path to recover more than it lost during the pandemic. We are seeing a slump, though, in Bitcoin, down about 9% right now at 32,700. Overnight, Beijing ordered the Chinese payment platform Alipay, along with some domestic banks in China, not to provide services linked in any way to trading of virtual currencies. Look at the ripple effect or the knock-on effect this is having. NVIDIA shares right now trading lower. This company relies on a lot of revenue for those graphics cards used in crypto mining. Mentioned to move up in long-term interest rates. We have a 10-year Treasury right now yielding 148. Interesting, though, that the dollar is down as much as it is. The Bloomberg Dollar Spot Index weaker by about 0.4%. Dow Industrial Average up 1.7%, and the S&P 500 higher by 0.7%. As we make our way to the closing bell in about an hour and 11 minutes from now. I'm Doug Prisner. That's your Bloomberg Business Flash.
Counting it down. All right, Doug, thank you so much. Well, this caught our attention reading in this morning about how workers are about to become much tougher to fire in New York specifically. Let's find out what's going on. For that, let's bring in Bloomberg News labor reporter Josh Idelson, reporting for Bloomberg Business Week. His story to be featured in the upcoming issue of Bloomberg Business Week magazine. Josh is with us on the phone in Chicago. Josh, this is a big story. Tell us what's going on.
So the United States is unusual in that most people here work under what's called at-will employment, meaning that they can be fired at any time for almost any reason or for no reason.
Oh, we know that in New York.
I was going to say, many listeners might have experience with that.
And there is now going to be, starting July 5th, a rare new groundbreaking exception, which will be the 70,000 fast food workers in New York City, because legislation was signed into law in January after a several-year campaign that promises fast food workers what's called just cause, meaning that you can't be fired without some reason related to either the economic circumstance of the company or your misconduct. And there are protections for what's called progressive discipline, that if you don't do something egregious, you need to be offered a system of warnings. There's a seniority protection that layoffs should be done based on how long people have worked there, and an opportunity for workers to enforce this either through a city agency or in court or in arbitration. And so this will make New York fast food a little more like Europe and a little less like the rest of the United States.
So, Josh, why just fast food at this point, or why fast food? Because as you point out in your piece, you write that many different types of professionals are at-will employees. You use the example of Google software engineers, Wells Fargo bankers, Mayo Clinic surgeons. These people all work at will.
That's right. The reason that this happened in fast food, in part, is because there's been a history of activism by fast food workers over the past several years. We've seen the strikes of Fight for 15 activists in fast food companies translate increasingly into city and state policy. The fast food industry also is known for having high turnover. It's also a type of work that is harder to outsource. You're not going to have an easy time getting a burger in New York served to you by someone in New Jersey. And it is an industry that council members in New York felt comfortable making this significant change in. It's been harder for the same advocates to win broader protections, and an effort to win just cause for essential workers in New York City fizzled amid opposition.
You know, and you do talk about conversations that Business Week you had with various workers, the reasons why they were fired, for noting that a manager showed up 2 hours late, for suffering a panic attack on the job after being subjected to racist harassment, and for disclosing to coworkers that they'd contracted COVID-19 specifically. Like, you sit there and you like, wow, that is pretty rough. First of all, there's an individual that's been very key in getting this done. Talk to us about this.
That's right. This is in part a story about Brad Lander, a New York City councilman who has been pushing the envelope in terms of what local governments can do to transform workplaces. In his time on the council, he co-founded a national group, Local Progress, which tries to spread progressive legislation at the city council level around the country, and the New York City Progressive Caucus, which has worked to push the council in a more ambitious progressive direction that we've seen play out in legislation regulating things like when workers find out about their schedule, when freelancers are paid sick days, and now this groundbreaking fast food just cause law. And Brad Lander told me that he's been honored to be an instrument for fast food workers. I talked to advocates who discussed how he's not just a politician you go to and plead for support from, but he's someone you actually can brainstorm with and collaborate closely with to come up with a strategy and then execute it, as happened here in his partnership with the Local Service Employees International Union affiliate in developing the research and the allies and the legislation and the campaign that over a couple years got this done.
Josh, as you point out in your piece, perhaps unsurprisingly to many, the restaurant industry pushing back on this new law. What have they done? What can they do? What power do they have?
The restaurant industry has brought a lawsuit to challenge this law. The law is set to take effect on July 5th, and the lawsuit is not scheduled for an initial pretrial conference for a couple months. So the law is on the cusp to take effect, and the challenges that we've seen to other legislation from the restaurant industry have been unsuccessful in several cases. The lawsuit suggests that the company's right to a trial by jury and to equal protection is being violated by the law, and also that it conflicts with federal labor law. But the city has said it will vigorously defend the law.
You do wonder too, Josh, and we've done a lot of reporting, you have the Bloomberg at Large, Bloomberg Business Week, just about how, unions have been, waning in terms of membership and their power and influence. And you do wonder if this is the beginning of maybe the tide turning a little bit when it comes to workers.
There's a complicated dynamic here in that as unions have declined in membership and clout, we've seen city lawmakers being increasingly aggressive, responding to pressure from unions and advocates in trying to find ways to use legislation to extend to workers some of the protections that in another time more people would have through a union contract. And Just Cause is a perfect example of this. Now, there are people sometimes who say, well, if you legislate enough of these protections, then people won't have a reason to organize. But advocates like Brad Lander and others say it's really the opposite, that one of the reasons it's so difficult to organize a union in the U.S. is that even though on paper it's illegal to fire people for organizing, it's very difficult to vindicate that protection when the company has the right to fire someone for no reason at all. And so giving people more security on the job, making it harder to use a pretext to weed them out, will make it easier for workers to come together and organize and follow up a victory like Just Cause protection by winning a full union contract.
All right, we're going to leave it there. Josh, thank you so much. Josh Idelson, labor reporter at Bloomberg News. His story in the upcoming issue of Bloomberg Business Week, out later this week and online and on the Bloomberg. For those of you listening in New York, D.C., and San Francisco, watching on YouTube, Bloomberg Business Week continues. If you're listening on Bloomberg 106.1 in Boston, Bay State Business is next. Did you have a thought?
I did. I'm wondering if this goes to other types of workers.
Yeah,
beyond the restaurant industry.
Right, some momentum. We'll be watching.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
3 p.m. on Wall Street. We have an hour remaining in today's trading day, and it looks as though at this point we're going to end higher. The equity market certainly recovering from that slump on Friday. The reopening trade is one reason why. We heard from St. Louis Fed Bank President Jim Bullard earlier saying the American economy is booming and it's on path to recover more than it lost during the pandemic. So we're seeing strength among energy, financial, and industrial shares, leading the S&P higher by about 1.3%. That's pretty much what we lost in the Friday session. Dow Industrial Average higher by 1.7%. And the NASDAQ composite is up about 0.8%. Now, at the same time today, with regard to the Fed, we had a little bit more on the tapering process. Dallas Fed Bank President Rob Kaplan was saying he favors beginning tapering sooner rather than later. We have a 10-year Treasury now yielding just under 148, so we've picked up about, let's call it 4 basis points on the day. We are seeing weakness in Bitcoin off the low, though. Nonetheless, off about 8.5% in New York, trading 32,785. Overnight, Beijing ordered the Chinese payment platform Alipay, along with some domestic banks in China, not to provide services linked to trading of virtual currencies. And look at the knock-on effect. Shares in NVIDIA right now trading lower. This company sells the graphics cards that are used in crypto mining. This comes under the heading of chasing yield. Insurance companies have been ramping up their purchase of junk bonds this year. Bank of America now saying life and property insurers have an estimated $240 billion worth of U.S. junk bonds. That's up about 23% from last year. Seeing some dollar weakness right now with the Bloomberg Dollar Spot Index down about 0.4%. We also have weakness in the Japanese yen, a little bit of weakness too in the offshore Chinese currency. I'm Doug Krisner, and that is your Bloomberg Business Flash.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
So safe to say we're still digesting the aftermath of the recent G7 summit of leaders, and another big miss was one on climate change. As Bloomberg New Economy editorial director Andy Brown writes in his weekly column, China, Tim, got a big pass this time around.
Yeah, that's what Andy Brown thinks. Unfortunately, he's joining us now to take us deeper into it. As you mentioned, Carol, editorial director at Bloomberg New Economy. He's with us in the Bloomberg Interactive Brokers Studios. Andy, so take us back to the G7. How did the G7 nations punt when it comes to climate change, and why is that so good for China?
So in the run-up to the G7, there was a real sense of expectation, anticipation that the G7, led by the U.S., was going to come through with a green alternative to China's Belt and Road Initiative, this $1 trillion infrastructure plan, which is now about 13 years old. And, you know, the reality is that we really do need an alternative to the Belt and Road, right? I mean, the bulk of the funding so far has been around transport and energy. And within the energy segment, in 2018, 40% of all of the investment was in coal, right? Coal-fired power stations and coal itself, and not just coal-fired power station. The very worst technology, the most polluting technology that China has, essentially China is dumping its defunct coal-fired technology on developing countries. And so, you know, the G7 announced that it would come through with this big initiative, and in the end, there was absolutely nothing there in terms of funding or in terms of detailed plan. It was essentially a plan to talk about a plan.
Yeah, we're getting a lot of that, right? A plan about a plan, and nothing really getting done. Why didn't they do it, Andy? Do they not have a plan?
Well, they have a plan to set up a task force to study it. You know, the truth is that they don't have a strategy, they don't have a vision that is able to match China. The disappointing thing is they put this up, the Biden administration put this up as an example of how democratic countries can, have a superior model, and we were going to, that the U.S. was going to show up the autocratic model as promoted by China. Infrastructure is incredibly difficult to do. Multilateral institutions more or less got out of the game
we
a
can't
long
even
time
do it
ago.
in the U.S.
That's the point. Here you have the Biden administration with their infrastructure plan being absolutely savaged in Congress by the Republicans, and going overseas and promoting this, as they called it, the Build Back Better World, B3W. I mean, it was such an unfortunate name to start with.
It just made me, I didn't see that acronym until I read your story. I mean, it kind of it speaks to the way that it didn't catch on.
Right, exactly. Well, so what's the implications of this? Because then China just continues on its merry way.
Yeah, so the implication is that poorer countries are going to be installing coal-fired power stations now, which will be spewing pollution over the lifetime of the project, which is usually about 20 and 30 years. But worse than that, the sense of disappointment really does put a cloud over the big COP26 climate meeting in Glasgow. That if you want to keep global warming to within 1.5 degrees, which is of course the global goal, you've got to get the developing world on board. And this made it less likely that they're going to come through with more ambitious commitments in Glasgow, and cast doubt about their participation altogether.
I don't get it, Andy, because these have been conversations going on for a while in terms of certainly climate change and climate impact, and how if we all don't get together, this is a global problem. There are consequences, obviously, for our environment, but there's also economic, financial costs as well. So why is it that we can't kind of figure out a way to do this and certainly combat what China's doing, or provide an alternative plan?
One of the issues is actually finding projects to invest in. So it's not as though there isn't money for this, right? I mean, there's something like $110 trillion of money sitting in wealth and money management funds.
Right.
The question is finding a way to get the private sector involved. Now, this was actually at the core of the plan. To talk about a plan was to use public money to catalyze private money. But private money isn't going to go in unless there's a pipeline of bankable projects to invest in, and the government comes in first. And a lot of it is going to be around building capacity in developing countries so that they can make the best use of investment that's coming in. But there's been so many examples of investments that China has made in places like Venezuela, places like Pakistan, places like Sri Lanka that has run into trouble precisely for these reasons.
You opened up our conversation by talking about the Belt and Road Initiative, 13 years in right now. What is the ultimate goal with the Belt and Road Initiative, and does it change in the coming years?
The Belt and Road people talk about it in terms of trillions of dollars. It's not. I mean, it's probably going to end up as around hundreds of billions of dollars, more than the money itself. Look, and the developing world needs something like $40-50 trillion in the short term, right? So even at $1 trillion, it's not going to fulfill a fraction of what the developing world needs. It's about values. It's about bringing countries in the developing world into China's orbit. Hence, the Biden administration framing of this as being a battle of values and substituting democratic values for the values that China is putting in.
It does feel increasingly like the developing world is beholden to China, right? Because of these projects, these connections, these relationships.
Indeed. This is what the Marshall Plan was all about, was exporting U.S. values to Europe and building a platform, alliance structure, free markets, democracy, far more important than the $13 billion that the U.S. put into the plan to rebuild Europe, about $130-40 billion in today's money.
Well, it seems like another missed opportunity at the G7 for, I feel like, on many different levels.
Yeah.
So what are you watching, though, when it comes to what might come next out of this, just quickly?
Watching the impact of this on COP26 in Glasgow.
Okay, good stuff. Andy, thank you so much. Really appreciate it. Bloomberg New Economy Editorial Director Andy Brown. Check out his new column, and you can find that on the Bloomberg and at Bloomberg.com. Off to Nancy with Lions we go.
Hey, Nance, World of National News. Take it away.
Hey, Tim, thanks. The White House is calling today Child Tax Credit Awareness Day. But as Bloomberg's Nathan Hager reports, some tax professionals say the Biden administration might not be telling the whole story.
Under the federal pandemic relief, the Biden administration increased the child tax credit for 2021 and directed the IRS to deliver half the amount in monthly checks starting in July. They're worth up to $300 for kids under 6, $250 for each kid 6 to 17 years old. But some tax preparers are advising their clients to opt out of the benefit unless they absolutely need it. That's because the credit is based on 2019 or 2020 tax return information. If a taxpayer's salary or job situation improves in 2021, they might have to pay some of that money back next filing season. In Washington, I'm Nathan Hager, Bloomberg Radio.
There's still no deal on infrastructure despite efforts underway among a bipartisan group of lawmakers. In an interview today with Bloomberg, former Treasury Secretary Steven Mnuchin emphasized the need for some sort of deal, and he offered ideas on paying for it.
There's a lot of money left from the pandemic funds last year. We passed over $6 trillion of funds. There's still significant money that hasn't been used. I believe that can be recycled. And I think the bipartisan group can look for across the board. There may be some pay-fors that don't have significant impact on the economy.
The Biden administration does not want a hike in the gas tax or user fees. Facebook is launching podcasts and live audio streams in the U.S. to compete with its rivals. Facebook says it'll allow public figures with verified accounts to start live audio rooms and invite anyone else to speak. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. A story that we want to bring to your attention. Banque Pictet and C promoting a woman to its top management body for the first time in its 216-year history.
Yeah, Elif Aktug, a fund manager at the bank's asset management arm and part of a broader leadership group, was named a partner alongside the founding family member, Francois Pictet, bringing the number of current partners to 9. That's according to a company statement on Monday. Carol, so far, the secretive Swiss private bank has only had 43 individuals, all of them men, all of them white, serve at the highest level.
And this mirrors a lot of stories that we talk about when it comes to the financial world and the inability in terms of diversity, inclusion, women, minorities. Firms talk about it, and they are, I think, safe to say, aggressively working on it to improve the situation. But it's just a reminder that there's milestones like this still yet to be done.
The firm, it's based in Geneva. The partners oversee more than 600 billion francs, that's $713 billion in assets. The bank also boasts a level of profitability far beyond larger publicly listed peers.
And listen, it's a firm like this that's got a lot of history, a lot of culture embedded in that history. And so as Pictet looks to expand internationally, specifically its wealth arm, what they're finding is they're coming up against a cultural clash among employees as it seeks to boost growth while also preserving that unique culture that has developed over a couple of centuries. So they've been hiring aggressively in both wealth and asset management arms, but has gone through a tumultuous restructuring in the wealth division where it recently introduced rigorous targets to measure the performance of bankers. And this is where maybe it comes down to some interesting metrics.
Yeah, we've also seen Pictet suffer some of the same well, I don't want to say consequences, but same fate as other institutions here in the United States when it comes to the talent wars and retaining employees. Just this year, the bank lost about a dozen wealth management employees in its Asia business, a coveted growth market, following departures over the last 3 years in its other markets.
All right, just some of the metrics too, as I mentioned, metrics, just watching in terms of some of these financial firms as they look to diversify and be more inclusive, especially when it comes to senior management. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
We've got less than 43 minutes until the closing bell for the Monday session. A lot of positivity in the equity market. Let's find out more. We'll cross to the Bloomberg Macro Squawk Desk and bring in Bill Maloney. Hey, Bill.
And good afternoon, Doug. U.S. stocks with an aggressive bounce after Friday's sell-off. The Dow's currently up 573 points. S&Ps are up 55. NASDAQ rises by 101. The U.S. 10-year yield at 1.48%. Gold is up 20. Transports gained 286 points. But Bitcoin is down by 9%. Among the main 11 S&P sectors, all were in the green, led by gains in energy and the financials. And all the stocks in the Dow were also in the green, led by gains in American Express and Chevron. In other news, Lordstown Motors said the company is evaluating strategic partners. DoorDash and Albertsons partner on grocery delivery. And Ray Dalio says he doesn't think the Fed can tighten more without a negative effect. Wrapping things up, Unifrax is buying Lidl for $62.10 a share. The stock is up 85% right now. Live from the First and Breaking News Desk, I'm Bill Maloney. Doug?
All right, Bill, thank you for live audio right on the Bloomberg terminal. The function is SQUA, then the green go key. I'm Doug Krisner. That's your Bloomberg Business Flash.
It is indeed. All right, Doug Krisner, thank you so much. So we love this column. She tells it as a Bloomberg opinion columnist, but also as a millennial, about the retailer with an old school feel that just might win big from the home buying frenzy. Should it draw in those younger first-time members? Membership required.
I didn't know there were many people who have never been to Costco, but we have one of those people inside our studio with us.
Well, she's been there now.
She has now.
She's all in on it.
It took a house purchase and a move to the suburbs, as her column points out. Tara LaChapelle is entertainment, telecommunications, and deals columnist for Bloomberg Opinion. She's here with us now in the Interactive Broker Studio. What was it like when you first walked into Costco, Tara?
That's exactly what I wanted to ask.
I'll be honest, it was a little overwhelming. You know, having spent a decade in New York City, living in an apartment, a walk-up apartment for that matter, where you don't really want to be carrying 36 packs of toilet paper. You know, to me, it was just a little much at first. You see these oversized shopping carts and everyone's scrambling to get food samples and sweatpants, and like there's sunscreen next to the engagement ring section, and it was just like very overwhelming for someone in the city. But over time, you really start to appreciate that you can get everything at Costco. And I mean everything.
I just had to take you back to my childhood because there was no Costco in my hometown on the central coast of California, not until I moved away. There is one there now, and it was always a special treat when I got to go with my parents to Costco. We would go about 45 minutes away to the nearest Costco. We would pack the car with a couple of coolers to keep things cold. And it was like a fun place to go as a little kid. I'd ride around on the cart, I'd go and get samples, and I'd, probably overeat. I would overstay my welcome there a little bit, but you got to get some pizza when you're there too.
Oh yeah, the food court is very good. I hear that's unique though to the suburbs. I hear in New York City they don't really have a lot of food options in the food court. So.
Well, it's a different story with Costco in New York City because I attempted to go once, and you have to. It's like everything in New York City, right?
It's always different.
It's always different, and there's not necessarily a room to store this stuff in your apartment.
It's like the original experience when it comes to retail.
Yeah. I mean, and I think that was maybe the perception issue Costco had, is that it felt like a little bit of a dated chain. And, you think of these very typical, old brands like Kellogg and General Mills, but really they've changed. And when you go there, I feel like they're really targeting millennials. They have a lot of fresh items, of course. They have tons of newer brands, vegan brands, which I think is really surprising to see in a place like Costco because usually you only have a few options to choose from as it is.
Right.
And so I think they're doing a really good job of targeting young homeowners, getting these new members into their clubs, and that treasure hunt experience is still there. And for instance, Costco tried to do the click and collect, the curbside pickup that these other retailers have been doing during the pandemic. And it hasn't been working that well because they're finding that Costco shoppers want to go inside the stores.
It's like a TJ Maxx. You got to go inside. The
Exactly.
treasure hunt is so much a part of it. But if you think about their future, I mean, I have some older siblings that are all in on Costco, and, everybody exchanges their stories about like what they got. And there are items you can only get there that also kind of increases the luxury feel or the feel that you want to be part of the crowd. But they've got to get to that younger consumer consumer who hopefully will buy into this model and continue shopping for years.
And I think one way they're doing it is going beyond food. You know, if you go into Costco, if you went during the pandemic at all, they were ready for this housing bubble. Everything in there was to soup up your home and to be on lockdown and at home and having the right entertainment equipment and exercise bikes. They had everything. You go in this week, I was there last weekend, they have everything for the summer cookout, to have a party in your backyard, string lights, fire pits, reclining outdoor chairs. So they are really targeting young people, people who want to entertain. They're keeping up with the trends, and I think that's another way they're bringing people in, this notion that it's not just to stock up on food, it's to furnish your entire house.
Right, one-stop shopping.
Well, the word experience comes to mind, and it's a way that, you know, a lot of retailers were thinking about things before the pandemic. What can we offer people experience-wise that they can't get online? Is there any online competition right now, serious online competition to the experience and what Costco offers? Because shareholders have really rewarded the company in recent years.
They have. The stock is quite expensive relative to Walmart and Target, so it remains to be seen where that goes. But I think, you know, there could be competition. I think where Costco wins is that it has that treasure hunt experience, but also the fact that their prices are very good. And, you know, they have everything. I think, you know, when you go on Amazon, something I've run into sometimes is you end up with a fraudulent purchase. You know, something wasn't what you thought it was going to be, or, you know, the quality isn't always there. With Costco, I think they've developed this perception where they have quality items. The Kirkland brand especially has a lot of good reputation around that.
And that's an in-house brand, which we know, like, you know, at a supermarket, like, oh, it's the in-house brand. And I think about Whole Foods has been trying to develop their in-house brand, but Costco with Kirkland has done really well.
Yeah, I mean, Warren Buffett was talking about it at one of the recent shareholder meetings. I think it was 2019, and he said they own Kraft Heinz, and he said, you know, what Costco has been able to do with Kirkland, I mean, it's one of the biggest food companies in the world. It's bigger than Heinz, which has been around 150 years.
Mind-blowing.
Does as much business as Coca-Cola. So, I mean, that right there shows you just how powerful they've become. And I think that's their strength. You know, they're not the convenient online store like Amazon, but they have these other strengths that really do appeal to people.
There's this wild kind of one-off story every few months or every few years about something that Costco has, right? A huge diamond, a private jet membership, something like that.
Yeah, I think they sold was it a $200,000 engagement ring? It was like on their earnings call one quarter because it was such a big deal that they did that. But I mean, you can basically get anything there. They have all these different vendors they're attached to. So I mean, the running joke is like pretty soon you'll be able to buy a house through Costco.
You can already get a car through Costco.
Exactly.
What's the membership cost? I don't even know. I'm not a member.
We're executive members. I think it's like a couple hundred or something, but you get cash back at the end of the year, and there's all these perks you get. So it's like, that's the thing. I don't even know how much it costs because it's just so worth it that we don't even think about it.
Did you buy the string lights for outdoors?
We're looking to get the string lights.
I knew it.
Carol, you got to get yourself to a Costco.
There's not one.
Maybe Tara will take you as a guest.
Yes, we'll do a field trip.
Come home with like the station wagon filled. Tara LaChapelle, good stuff. Entertainment, telecommunications, and deals. Columnist at Bloomberg Opinion. Check him out on Bloomberg.com.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So have you bought anything for Amazon Prime Day?
You know what I was thinking about, Carol?
What?
This Prime Day feels different than every other Prime Day.
Why?
I don't know.
I'm never a shopper on Prime. My husband
I'm
is.
not
but
either, but it seems like Prime Day, this holiday that Amazon invented, based it on Alibaba's Singles Day, it doesn't get the same kind of press that it used to. Could be because this is the second one in a year.
Right. And we're also seeing some things that are going on with merchants, I think, that are giving a little bit of a damper. We're going to dig into it in just a moment. In the meantime, let's get back to your top business stories. Another check on that trading day. Doug Krisner, 29 minutes to go.
You're right about that, and I want to begin with this hot headline from the Bloomberg terminal. ExxonMobil, we are told, is preparing to reduce headcount at its U.S. offices by between 5 to 10% annually for the next 3 to 5 years. They'll do so by using performance evaluations to kind of find low performers, so to speak. The stock in ExxonMobil right now is higher by 3.7%, but generally speaking, we're seeing a rally in energy shares across the board. That's coincidental with a rally in crude oil. WTI now in the extended trading session here in New York, up about 2.6%. We're trading 73.50, and it's the gain in energy leading the S&P 500 higher by 1.4%. Dow Industrial Average, meantime, better by 1.8%. NASDAQ Comp rising by about 0.7%. Also seeing strength among financials. This is due in large part to a move up in long-term interest rates. 10-year Treasury now adding nearly 5 basis points in yield. We're at 148. Generally speaking, the reopening trade is in high gear. We heard from St. Louis Fed Bank President Jim Bullard earlier saying the economy is booming and it's on a path to recover more than it lost during the pandemic. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, Doug Krisner, thank you so much. Well, check it out on your calendar. Amazon Prime Day, it is underway. It's a 2-day event, and it arrives as the world grapples with the lingering effects of the pandemic. So, as you said, it feels a little bit different this time around, Tim.
It does. Does it to you feel different, John Ehrlichman, who's an anchor at BNN's Bloomberg The Open, also a correspondent for CTV National News. He joins us now on the phone from Toronto. Does it feel different, the coverage of it, John?
Well, locally, literally, it's different because we're still getting through the pandemic in spots in the world, and Canada's an example of that. So Amazon said to their employees, you know what, we're not going to make you deliver stuff for Prime Day 2021. They postponed it. It was postponed in India as well. But I get what Tim was saying before the break. I mean, in some ways, we are a bit Amazoned out. We've been getting boxes from them. Yeah, no, it's amazing. But, look, I think at the end of the day, there's a really important business story in what Amazon has done to what Tim was saying earlier. They did create this. They might have pulled from the Alibaba playbook, but now they've got all the other retailers, which in many ways for the last decade, it's already been the case, scrambling to try to get deals that are comparable to win some business. So you've got some headlines today that are about Walmart or Best Buy or Target grabbing some of that big boatload of cash that is available over these next couple of days of spending. I think that just is a reminder of how much of a lead Amazon has these days.
So remind us what this was all about, Amazon Prime Day.
Well, Carol, you go back to 2005 and they launched Prime, which initially is based on the idea that if you've got something that lowers the shipping costs every year for people who are ordering with us, maybe we can reward them with some different things. They rolled out the video service within Prime early on, and they gave different benefits. The Prime benefit always, no pun intended, was to get your stuff faster. Mm-hmm. So if you're going to order a certain amount during the year, it pays to have a Prime membership. And then 10 years later, so about 6 years ago, they launched this Prime event. Undoubtedly, they had seen the success that Alibaba was starting to enjoy by having a single focused event outside of the normal holiday season where, let's face it, Amazon has helped to lead the way on Black Friday and Cyber Monday sales for the last decade. So why not take a slower period during the year where people aren't really all that enthusiastic about shopping. We're more trying to enjoy some of that nice summery air outside and try to smooth out the sales picture. But, I think as much as it's going to be about selling stuff, this is also a chance for them to sign up more people for Prime, because the numbers have told us, guys, that, the average person who signed up for Prime, and there are a lot of Americans. I mean, they've got like 60% penetration already, but that means there's 40% of the population they can still grab. On average, they spend more over the course of a year, and Amazon is undoubtedly hoping that over these next couple of days, just the fact that people are literally saying Amazon Prime Day is going to lead to some more subscriber signups.
If you had a Roomba, you can save like $300. No, I think I remember years ago, I think we bought one because it was like the price was slashed dramatically.
Yeah, the deals aren't, and they're not incredible. And let's not forget, we're still dealing with some of these supply chain issues because of the pandemic. So some people say that sort of put a lid on some of the deal. I don't know. I mean, I saw on the site a nice silk pillowcase. It's like $20. I mean, my wife and I have more throw pillows than we need, but we're always enticed to buy more. But I think that we will see at the end of the day how successful this is. Even if we feel a little Amazon primed out, the reality is the overall sales could come in at some just astronomical number, $12+ billion. It is astonishing.
It's a lot of money. We too sleep on a bunch of throw pillows with a bed somewhere underneath. I'm just going to say. Anyway, Tim, go ahead.
Well, I'm just wondering, the opportunity for Amazon to continue to grow its Prime membership, John, because as you mentioned early on when it came to Prime Day, it was all about getting more people into Prime. But really, Amazon is to the point now where it's looking for other areas of growth, because so many people who would be getting Prime, at least in the United States, a lot of them have got to already have signed up for Prime, John.
Yeah, you're right. And so I think if you're looking at the raw numbers, Tim, as I was saying, they're at about 60% penetration. So that's still that's a lot of people, but it's still a whole bunch of Americans that could still come on board. And the penetration rate globally is lower. So I think if there's people talking about this online, as I say, even if they're not technically having Prime Day in Canada or India this year, around the world, people are going to hear something about Prime Day, and maybe they sign up the same way Netflix is a global service. But I go back to the moat, because as most made great inroads, and Best Buy has done a great job as well of bringing their business forward. You look at the numbers, and Walmart, an example of a company that is still generating more revenue each year than Amazon, but come next year, that is going to change. I mean, it's not an if at this point. It's pretty clear that Amazon will have the title of biggest revenue generator in the United States come the end of next year.
Right.
And then it's like a hockey stick. I mean, they're on pace, according to the analysts, 5 years after that to get to like $1 trillion in revenue. Now, to Tim's point, outside of this business, the cloud and the advertising stuff they're also doing, that's also driving their revenue.
All right, we got to run. Hey, John, thank you so much. Enjoy those silk pillowcases. John Ehrlichman of BNN Bloomberg's The Open, correspondent for CTV National News.
Let's get to World and National News with Nancy Lyons in D.C. Hey, Nance.
Hey there. The White House will be closely watching a big test vote in the Senate tomorrow concerning voting rights. Press Secretary Jen Psaki called an expansion of voting rights a huge priority for President Biden, even though the measure is unlikely to receive the 60 votes needed to move forward.
Our effort, the president's effort to continue that fight, doesn't stop tomorrow at all. This will be a fight of his presidency.
Republicans call the Democratic bill a huge government overreach. Democrats say it's needed to counter efforts in Republican-led states to change election laws. An official with the U.S. State Department is reacting to the election of a hardliner to be the next president in Iran. Officials say the election was not free or fair. The president-elect Ebrahim Raisi is demanding an end to American sanctions on his country and Washington's full compliant return to the 2015 nuclear accord. Afshin Malavi of the New America Foundation tells Bloomberg it is unlikely any nuclear deal with Iran would be expanded.
The lessons that we've learned from hardline candidates like Ebrahim Raisi is that they often never miss an opportunity to miss an opportunity.
Malavi says the next 6 weeks are critical. Iran and world powers ended a sixth round of negotiations on nuclear weapons this weekend. The Supreme Court today ruled colleges can no longer be prohibited from providing student athletes with education-related benefits. Supreme Court Justice Brett Kavanaugh wrote the NCAA is not above the law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
Thank you so much, Nancy Lyons in our DC bureau. So Steven Spielberg and his Amblin Partners, that's his company, signing a deal with Netflix to produce multiple films a year, giving the streaming service fresh ammunition as competition grows. Man, when it comes to the streaming wars, they are off and running.
They are. Well, they've already had a relationship, so they've teamed up on last year's The Trial of Chicago 7, also on a Leonard Bernstein biopic, Maestro, which is in pre-production right now. Terms of the deal, Carol, were not disclosed, but can you imagine a time just a few years ago when it would be sort of like unbelievable that somebody like Steven Spielberg, who is known for huge blockbusters, first-run movies in theaters.
On the big screen.
On the big screen, would sign a straight-to-Netflix deal? Like, that would have been, you tell somebody, 6-7 years ago that this would happen, and they'd be like, okay, that's a little crazy.
Green Book, 1917, E.T., Indiana Jones series, Jurassic Park, Saving Private Ryan. I mean, listen, when you think about Spielberg, incredible movies. But we have seen this happen over the last couple of years, that even big Hollywood names, right, doing limited run series. We've seen it with Reese Witherspoon truly embracing the streaming world and providing opportunities for other female actors. And so we are seeing really established names within the Hollywood community and the movie and entertainment business certainly embracing streaming big time.
To our earlier point, Carol, not long ago, Spielberg looked like a Netflix critic. Think back just to 2019. After the Oscars, he reportedly argued the streaming services, films, and shows should be relegated to Emmy Awards, which honor the best TV programming, rather than competing for the movie industry's highest honor. Netflix's Roma was considered the front runner to win Best Picture Oscar that year, but Green Book ended up taking the prize instead.
And so the world changes.
It does.
And listen, there's some big contracts we know going on when it comes to producers, content producers, to actors and actresses when it comes to the streaming world. And the streaming world is vying for your eyeballs. They want you to sign up, and they want to hold on to you.
Not a zero-sum game, though. I've said this for years, right? You want multiple streaming services. You don't just want one.
Well, and that's exactly. We now have like a buffet of streaming.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So we have less than 13 minutes to go until the closing bell for the Monday session. Equities, generally speaking, have recovered all of what they lost in the Friday session. We have the S&P 500 higher now by about 1.3%. Energy, financial, industrial shares out in front of this advance. We're seeing crude oil in New York trade just under $73.60 a barrel with a gain of about, let's call it 2.7%. Earlier in the day, St. Louis Fed Bank President Jim Bullard was saying the American economy is booming and it's on path to recover more than it lost during the pandemic. And that's not going to be a surprise if I were to say, hey, long-term interest rates are higher today. 10-year Treasury now just under 5 basis points in yield higher in the New York session. We're just about 149 on the 10-year. We also heard from Dallas Fed Bank President Rob Kaplan today. He favors beginning the process of tapering sooner rather than later, although New York Fed President John Williams was a little less hawkish. He said, it's clear the economy is improving at a rapid rate, but Williams said the data and conditions have not progressed enough for the FOMC to shift its stance on monetary policy. Once again, that 10-year Treasury 148 and some dollar weakness, interestingly, with the Bloomberg Dollar Spot Index down about 0.4%. I'm Doug Krisner. That is your Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
We've just got about 10 and a half minutes left in today's trading session. It is time for the drive to the close. Michael Sheldon is back with us. He is Executive Director, Chief Investment Officer at Hightower RDM Financial Group, based in Westport, Connecticut, which is where we find him once again. Michael, nice to have you back on an interesting.
Thank you very much.
Yeah, well, good to have you. In a day where we came off of a week where we saw some pullback in the equity market, some concern, I think, following the Fed decision, and now it looks like we're all in again.
Yeah, I think if you look back to the Fed meeting last week, that's sort of what created some of this volatility we saw in the market. And, if you look back to that Fed meeting, while much of the latest FOMC meeting was pretty much as planned, I think the big surprise was that members of the central bank turned maybe incrementally more hawkish. So I think from an investment point of view, any rate hikes are likely a year or two away. But it looks like the central bank is starting to indicate that they're likely to remove some of the policy accommodation in the not-too-distant future. And that's really reflecting the fact the economy is on better footing than it was a year ago.
Well, and I thought what was key is what you said, incrementally hawkish. They haven't become hawks all in. I mean, it's still a couple of years before we start, at least at this juncture, before the Fed starts to raise rates. And they're just kind of saying, listen, folks, policy will change.
Yeah, that's absolutely right. At the meeting after the Fed, when Powell was speaking after the meeting took place, he went out of his way to say the dot plot really just represents, this is what's getting a lot of attention, the dot plot basically represents the opinions of many of the Federal Reserve members, but it's going to change over time. And as you just pointed out, the Fed's going to probably taper before it starts to actually raise rates. So I think the markets may have gotten a little ahead of things, and basically the dollar, I think, was sort of at the center of things. And the dollar moved higher after the meeting last week, and a higher dollar caused commodities to go down, and that led to selling in value-oriented parts of the market. So I think you're starting to see a little bit of that rebound today, and we'll see sort of what happens from here.
Right. Well, what was the main difference between what we've seen today and what we saw at the end of last week when we saw, the biggest sell-off in so many weeks, the S&P 500's first decline in 4 as a result of comments from Federal Reserve officials?
Yeah, yesterday, on Friday, there was definitely some selling. I think it was the 4th day this year where the advanced decline line was -5 to 1 or negative or worse. So definitely there was some selling, but I think overall we still have about 85% of stocks in the S&P 500 above the 200-day moving average. So that's sort of a longer-term positive. And I think people just sort of had a little bit of a chance to reassess over the weekend.
And I think as you look ahead, I think the economic momentum is still positive this year. If you look at earnings, stocks tend to follow corporate profits. Back in March this year, the estimate for 2021 was about 25% growth, and now we're looking at about 35% growth. Next year, the estimate is still for double-digit growth, although clearly based on what happens to taxes and things in Washington, that could change. So I think there's still positive momentum out there, but I think the important thing is that returns in the second year of a bull market are typically a little more moderate, but still positive compared to what we were used to coming out of the downturn last year.
Right, but it doesn't mean things are falling apart. And I'm not trying to be a bull here, but I also, this is what we were looking for, the bounce back, right, after all this stimulus. If it wasn't happening, then we would really be in a bad way.
Yeah, you're absolutely right. And I think one of the things, we keep looking at a number of sort of leading economic indicators, so which basically tell us what's happening to financial conditions. So we look at credit spreads, we look at new orders, the direction of copper prices, for example, the performance of consumer discretionary versus consumer staple stocks. And most of these indicators remain positive, although there may be a little less bullish, at least over the near term, than they had been.
What changes that? What makes you question the recovery? Is it something related to the Delta variant? Is it something related to inflation?
Well, I think there are always some worries. As investors, you always need to sort of think ahead. One of the things is the Fed could raise rates more quickly than expected and surprise the markets. I really think the Fed's going to go out of their way to not shock the markets. They're going to telegraph things in advance so the markets aren't surprised. I think there's also the possibility that inflation could remain higher for longer. I think as we get into 2022, we could see some further wage pressures, and that could maybe rile the markets, but that's sort of yet to be determined. And then there's also the potential for higher taxes at some point in the next few months, and that's still a bit of a wild card at this point.
Well, and will there also be a little bit of a wild card and some volatility and tumult, if you will, because of the stocks that fared best during the risk-on rally from September to May, kind of the same ones that sold off in piles over the past month? And I'm looking at some of our Bloomberg Intelligence writing and reporting on this. You know, we're seeing those names that really propelled us in the bounce back here, but because of those gains, they are more vulnerable, right, or at risk to also selling off because they have gotten so ahead of themselves.
Right. Well, I think in this environment, we're clearly past the early stages of the economic cycle due to the vaccine rollout and also because of the incredible amount of stimulus that we had from Washington and also the Federal Reserve. So we clearly haven't started slowing down. You're not seeing economic data actually slow down. So we're probably sort of moving towards the middle part of the economic cycle, but we're not quite there yet. And, you know, one thing to keep an eye on is new orders and the ISM index. We could be at elevated levels, meaning strong levels for several months or quarters to come. I think from an investment perspective, you probably want to focus more on a barbell. So that means you want to have some exposure to, for example, technology and consumer discretionary. We're still big fans of technology despite the volatility. For example, e-commerce penetration last year went from about 15% to 19%, so there's still more room to go there. And then you want to have sort of healthcare as our sort of GARP sector, but then you also want to have some exposure to industrials and financials and areas of the market that will rebound. I think it's too early to give up on the value trade, but I think a barbell approach probably makes increasingly more sense.
So a lot of exposure to a lot of stuff, basically.
Well, you want to be a little more diversified. It used to be just technology the past several years, but I think in the current environment, as long as credit spreads remain healthy and the Fed doesn't sort of jump the gun, which I think they're going to try and avoid their best doing that, then I think there's probably more upside. And economic cycles typically last a number of years, not a number of months or quarters, so that's important to keep in mind.
Hey, Michael, how are you thinking about long-term economic growth in the U.S. when we get past the pandemic, when we get past the pandemic recovery and the sort of juiced-up version of the economy that we're seeing right now? What about when we get to the other side of it? What does it look like?
Well, that's a great question. I mean, if you look back over the last 20 years, real GDP growth has averaged about 2%. There have been some quarters that are higher, some lower. If you look at this year, for example, we're supposed to grow about 7.5%. So that's more than 3 times the average of the past 20 years. Next year, we're supposed to grow somewhere in the range of 6% or so. So that's about, 4% next year. So that's about twice the average. I think as you look ahead later towards the middle of this decade, I think economic growth will probably trend back to normal levels, which is probably in the 2 to 3% range. And weighing on that potentially is higher deficits down the road and potentially higher interest rates. So those are a couple of the variants that you want to watch, but also keep an eye on productivity. If productivity starts to rise, that could help GDP growth as we go through the next several years.
That's a good point. It was a favorite of Alan Greenspan for many, many years. Hey, good stuff. Thank you so much. Michael Sheldon, he's Executive Director, Chief Investment Officer at Hightower RDM Financial Group, joining us on the phone from Westport, Connecticut. Having said that, we are in the last few minutes of trading, and we are pretty much staying at our highs of the day. So we're seeing a rally in the S&P and Dow really outperforming, and we're seeing it as a broad-based rally. All right, coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio and Bloomberg TV and YouTube, counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Caroline Hyde, Taylor Riggs, Gina Martin-Adams in the house on TV, counting you down to the closing bell. And to help us take us to the bell, beyond the bell, the global simulcast, it is Carol Massa, Tim Stenovic, bringing together Bloomberg television, radio, YouTube audiences worldwide. And what a day, what a risk-on feel, Carol, to the market after last week's volatility.
Yeah, absolutely, Caroline. And really, right out of the gate, we kind of shot up in terms of the equity trade, and we've stayed through those highs and moving up just a little bit in the last few minutes of trading. Take a look at the major industry groups in the S&P 500. All of them are higher, and no doubt about it. Despite the back and forth with Fed speakers, Tim, investors risk on.
Yeah, talk about a broad-based rally here. Just green across the screen. Energy leading the way, higher by more than 4%. Even the worst performing sector, consumer discretionary, still eking out a game to the tune of more than half a percentage point, Taylor.
Well, I have to talk about full faith and credit. We're having an incredible conversation, Gina, with you before this segment, talking about how full faith and credit has been pretty volatile, to say the least. Overnight, if you guys slept through it, we dipped below 2%. We migrate northward now to a 210 on the 30-year, but it's within investment grade and junk spreads that haven't moved at all. There's a calmness there that you don't get within the volatile moves of are we hawkish, are we dovish, at a 148, Gina, on the 10-year.
I'm going to just fuel that a little bit more and throw a little more cold water on this rally, because I do think that the broader perspective here is we still haven't made up for the losses we had last week. We still haven't seen volatility fall back to the lows that we were at last week. And there's a really strong chance that this is just the beginning of a much more volatile range-bound trade for the equity market.
We braced ourselves. It was certainly volatile over in Asia. The Nikkei fell by 3.3%, but we shrugged that off in European trading, and we power towards this close, guys. S&P 500 closing up 58 points and a half. We're at 4,224 is where we settle at. Dow Jones, really your star performer, your cyclicals, your defensive. We're seeing energy, we're seeing financials get back in vogue. Dow Jones is your outperformer, up 586 points, up 1.8%. NASDAQ, big tech, the laggard, but we still had some gains, but some of your big heavyweights, Microsoft and the like, leading us higher. Some of the chip stocks didn't do so well. And the Russell 2000 is where we pan out to, up 2.2%, Carol.
Yeah, I was looking at that. Those small caps really an outperformer in today's session, no doubt about it. Economic cycles last a couple of years, not months or quarters. Michael Sheldon reminding us that, and he's saying stocks are going to follow corporate profits, so we have to keep an eye on corporate profits expectations, and ultimately, as we move into that next earnings cycle, what we hear from CEOs about the current quarter, the last quarter, and what's to come the rest of the year, Tim.
Yeah, can you believe that we're that close to the end of the quarter, guys? We're almost halfway through the year. The S&P 500 today closing 1.4% higher, the biggest gain, Taylor, since May 14th.
Well, and for the radio audience, when we take a look away from the macro and dive into the individual sector levels, all you need to know is it is green across the board. Even the decliners are green. Here's what the key winners are. Energy and banks are up 4.5%, 2.5%. The biggest gainers on the day. They're also the best performers on the year. That's really highlighting, Carol, some of that reflationary, inflationary trade that, frankly, the markets cannot get away from today. We go down to the losers, and well, it is still green on the screen. That's how broad-based this rally is today. There is one loser, it's semiconductor index, but that's basically unch on the day. So I'm just going to call this a pretty broad rally, Carol.
I think that's fair to call it a pretty broad-based rally. Let's go to some of the gainers in today's session. Moderna, definitely an outperformer, up about 4.5% in today's session. That stock specifically, we did talk about the company planning to add 2 new production lines lines at their rebuilt Polaroid plant, so they're going to be able to make more vaccines, supply more suppliers. I don't know if you saw the CBS report too, but they are talking about that mRNA technology being able to supply it and really address it to different vaccines and different treatments for various ailments. So that's certainly been one of the names that has caught our attention. And a meme stock, a new Reddit favorite, if you will, is Torchlight Energy Resources. Ticker is TRCH. That stock up 58% in today's session. Second biggest gainer on the NASDAQ this year. Also, APA Corp upgraded to outperform from market perform over at Bernstein. It's an E&P company, so playing into the oil sector. The analysts liking a lot of the names when it comes to E&P. And Apple, just want to mention, becoming the latest target of a German antitrust crackdown on tech giants' market power. So under the gun, we've seen this with some of the big tech companies. Investors shrugging it off, liking big tech. Apple up 1.4% today.
Okay, well, even though it was a broad-based rally, Carol, I had no problem finding several decliners here to talk about this afternoon. Bitcoin moving lower significantly, and when Bitcoin moves, being down by about 9% as we speak. MicroStrategy moves lower as well. Company shares closing down more than 9.7%. It said it bought 13,005 Bitcoins for about $489 million in cash. The average price, though, Carol, and everyone else, $37,617 per Bitcoin, but now Bitcoin is at around $32,600.
Can't win them all, Tim. Can't win them all.
I know. It's all about timing, right? Nvidia shares lower by more than 1% as well, and that's because of this crackdown on Bitcoin and cryptocurrency in China. Nvidia is one of the companies that makes processors that people use to mine cryptocurrency. Amazon shares lower despite Prime Day, down by nearly 1%. Uber lower today by more than 3%. The company said it was buying the remaining 47% stake in Cornershop, the online grocer.
Meanwhile, I'll tell you what's also down. Let's go cross-asset. The dollar. It is a story of dollar weakness today, rather helped by some of the comments coming out of Ray Dalio and the likes of Larry Summers over at the Qatar Economic Forum, powered by Bloomberg. I love that particular turn of phrase. But basically looking across currencies right now, if you're on our radio audience, I've got a green vertical on our global macro movers because every basic currency pair is up against the US dollar. The Canadian dollar fights on up 0.8%. British pound doing well as we have some commentary out of the reopening of that country despite that ramp up in the Delta variant. Swedish krona doing well despite the political turbulence that hit Sweden. I'm looking therefore at a story of commodity strength as we get the US dollar weakness. WTI crude up 2.7%. Brent crude also doing well, up at $74.92. Interesting moves into some of the metals as well. We were so sold off the relative strength index. That focus on technicals showed that copper was oversold, gold was oversold, so they power back onto the higher side. What also we see is a yield increase across the board worldwide, whether it be in Europe or indeed in Asia, Taylor. Gina, I know you've got some factors to watch there.
Yeah, just to hammer the point home that this day has been largely about a reversal of what happened last week. We've got some factors that we watch. The Bloomberg Factor portfolio shows value absolutely surging today, confirmed by a surge in momentum. We've talked a lot over the last couple of weeks about the overlap between those two styles, really reversing, but only partially reversing what was an absolute horrible week for value last week. And then look at the bottom of the screen where the port, really stable growth, low earnings variability stocks doing very poorly. So clearly a risk-on attitude has come back today, but is it enough to really make up for the losses last week? Not so far. We'll see what the rest of the week holds.
And we have to see what the rest of the week holds for some of these bond yields. You guys talk about whiplash, where we've been since last Wednesday. Today, the reflationary bond yield, higher, price lower, that is back in vogue. You're trying to creep back up to a 150 on the 10-year, but it's really the 30-year, that long bond action where all of the action has been after dipping below 2%. We're at a 211. And Carol, this really comes off of some big comments that we got on Friday from Mr. Bullard, hinting that indeed we need to start talking about tapering. We're doing it in a right way. Now is the right time. And we're getting some other comments that we got earlier today. You had Harker, I believe, Bullard, and another panelist, all as we await Jay Powell tomorrow, 2 p.m. Really, finally, I think discussing maybe we don't know if inflation is 100% transitory. Maybe that's not a 100% guarantee. What if it is not, Carol?
Well, a lot of Fed speakers. We will hear from Jay Powell tomorrow, as you mentioned, Taylor, at 2 p.m. Wall Street time. We also heard from Ray Dalio of Bridgewater. I mean, everybody is weighing in on what the Fed is doing. Check out what he had to say.
You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect.
All right. So, yeah, I mean, listen, we're all kind of getting used to what the Fed said. And I think at some point, don't we have to understand, Gina, you know this too, right? We're watching growth come back. We have to expect that the economy was going to bounce back. Companies were going to bounce back. And you want the Fed to ultimately react to that at some point and understand that policy, Tim, is going to change.
Yeah, absolutely. And look, I'll toss it over to you, Gina, but I think there's no shortage of hearing from Fed officials this week. And at the same time, the big question is, okay, so what changed between last week and the sell-off that we saw at the end of last week and sort of the rally that we saw earlier today? We asked that question earlier in the day to Michael Sheldon, Executive Director and CIO at Hightower RDM. He basically said, look, a little bit of chance to reassess over the weekend. And then he thinks the lesson that the Federal Reserve has taken, Gina, is that they're going to telegraph this. They're going to make it clear, Gina.
Yeah, I think that that's everyone's hope, but certainly the signal that we got last week is that the market was unprepared for even this modest move higher in the dots. We haven't even gotten to the point of talking about taper. We're still talking about taper. What happens when we actually start to talk about taper and we get some guidance as to what that's going to mean for the supply of bonds coming to the market? Who's going to buy those bonds in the environment in which inflation is accelerating right now?
No, that's
I think that's a huge question mark. It was brought up by Ray Dalio at the conference today. Will we see a lot of turmoil emerge as the Fed starts to try to taper or not? We don't know, but my sneaking suspicion is we probably will see higher volatility.
And we don't have the playbook on this one, so we're going to be all watching it in real time, that's for sure. All right, guys, we got to wrap. That'll do it for our cross-platform coverage on Bloomberg Radio, Bloomberg TV, and on YouTube. We'll see you again, same time, same place, tomorrow.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Such a Monday. I have all my papers like flying all over the place today.
Yeah, you're not the only one.
It's going to be an interesting one. We will be talking so much about Fed policy tomorrow, of course, of Jay Powell testifying up on Capitol Hill.
Like I said, no shortage. By the way, can you believe that Fed Chair Powell and Biden, this is the first time meeting face-to-face?
It is interesting, right?
Yeah.
And Fed, we're going to find out if Jay Powell, right, whether or not he gets another term under the Biden administration. You have a great evening.
Thank you. You too.
We'll see you tomorrow on Tuesday. Right now, let's get to World of National News and Nancy Lyons. She's in D.C. Hey, Nance.
Hey, Carol, the White House is still pushing hard to boost COVID vaccinations before the 4th of July. President Biden wants to see 70% of adult Americans with at least one shot by the upcoming holiday. Press Secretary Jen Psaki says they're not giving up.
We're still going to be vaccinating people on July 5th, on July 7th, on July 10th.
Psaki says they've seen a lag in vaccinations, especially among many young adults. Vice President Harris says the child tax credit will make a big difference for struggling families. She traveled to Pittsburgh today and noted that child tax credit payments will start going out July 15th. Families will receive up to $300 for each dependent child in the household.
That could cover a month of rent, a few months of groceries, an entire year of diapers.
Harris says the child tax credit runs through the end of the year, but the administration is hoping to make it permanent. The U.S. Supreme Court is siding with student athletes in a case concerning greater compensation. The nation's highest court, in a unanimous ruling, rejected the NCAA's effort to limit educational benefits like computers and internships. Loyola Law professor Jessica Levinson says the NCAA had wanted broad antitrust immunity.
The Supreme Court did not give a green light to paying college players, an issue that is sure to come up in the near future, because the lower court had not said that those restrictions necessarily violated the antitrust law.
Levinson says today's ruling is, though, a victory for student athletes who have been limited up until now to receiving tuition, room, and board as their only compensation. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. You're listening to Bloomberg Business Week. Joining me right now is Doug Krisner. And Doug, of course, host of Bloomberg Daybreak Asia, coming your way in just a couple of hours. So half of London firms planning for home, working 5 days a week. I was on a conference call talking about how work is shifting. And this was one of the stats that I brought up. It depends on where you are, Doug, that we are seeing different scenarios play out post-pandemic.
You know, it's curious because today would have been the day at which the British Prime Minister earlier wanted to lift most of the restrictions that had been in place, but they're dealing with, obviously, the Delta variant in the UK, particularly in the city of London. And so that's been pushed forward to the 19th, right, of July.
Correct.
But that's part of the zeitgeist here, right? We're very much concerned about variant strains of COVID-19, and this has got to be supporting this idea that, hey, until we're completely convinced that we've got the upper hand here, doesn't it make sense to work from home?
Don't you think? Yes. But I also am wondering what kind of conversations are going to go around the C-suite of, okay, wait a minute, if we have them at home, we get to cut some of our overhead costs, right? So that could be an advantage for a firm. But secondly, you do wonder about, okay, wait a minute, we lost that job because our folks weren't in the office and they couldn't have a meeting with a client. So this conversation I was having with, it's a setup for a bunch of CEOs. It's going to be different. It may not be everybody working at home, but it may not be everybody working in the office. And maybe we need to think about how work has changed since the Industrial Revolution required that we all be in one place to get something done.
Well, we've got the technology, right? But then when you tease out the service industry, right? There are figures as part of this study that was put together by the London Chamber of Commerce that shows the impact on other businesses that are related to, let's say, the office culture. They're going to be negatively impacted by this.
Yeah, exactly. And you're right. And we need to kind of make the distinction between different types of workers, because different types of workers are impacted differently as a result of some of the changes coming our way because of the pandemic. Doug, thank you so much. Doug Krisner. You bet. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
All right, you're listening to Bloomberg Business Week. Carol Masser in our Interactive Brokers studio. And this on a day where we did see quite a rally in the equity markets, really that risk trade on once again, and investors still trying to assess what is going on when it comes to Fed policy and what it means ultimately for our economy. And that is something I want to dig into and a lot more. Last week's Fed decision, the Fed speakers coming up. We still have millions out of work. You know, when it comes to inflation, transitory or transitioning, which is how I like to put it, is that where we're moving to? And we've got a great voice to get into on all of this, and one that's been writing about the age of scrutiny, spelled S-C-R-E-W. And he's getting a lot of feedback on that as well. Let's get into it with Peter Atwater. He's adjunct professor of economics over at William & Mary. He is back with us, and he's on the phone in Pennsylvania. Peter, it is definitely a Monday. How are you?
I'm doing great, Carol. Thanks.
Well, it's good to have you here. And I do want to talk about Fed policy, but I do love the writings that you are talking about when it comes to the age of scrutiny. Tell me a little bit about what you've been writing about. What's kind of the next either financial crisis or wrongdoing that we might be dealing with?
Sure. So I've been watching, as I always do, human behavior. And it's been fascinating to see in this cycle, particularly in the last, say, 18, 24 months, where attention getting has been sort of the principal objective, whether you are a SPAC partner or a meme stock. The whole focus has moved to what I call illusion, that our business leaders are now trying to captivate an audience. And this is a very different cycle phenomenon. And it concerns me because at the same time you have all of these very charismatic, very powerful leaders talking about the promise in EVs and the promise in space and the promise in all of this futuristic technology, you're starting to see companies where that illusion was false. You saw that with Luckin Coffee and Wirecard and Greensill and Nikola. And most recently, we're seeing this being brought forth at Lordstown Motor, where the crowd is beginning to wonder what was real and what was fake.
But the coming age of scrutiny, it feels like in some ways, Peter, it's a good thing. And it's interesting how I feel like in terms of cycles, market cycles, when there's things going wrong, investors are kind of quick to get the bad news and kind of push for the bad news to be out there, whether via an activist investors or the retail investor. Like, it feels like we get to it much more quickly. Is that fair?
Yeah, but I think so far the crowd has shaken off any sense that there is a systemic issue. We've treated each of these as if they're independent, but I think we're rapidly approaching a tipping point where it feels like there's too many of these happening at once. And that then raises a question as to what is real and what is illusion much more broadly. And you put it all together. What happens or what's the outcome? I mean, we've gone through, the financial crisis. We've gone through the tech bubble. We've gone through certainly the pandemic. Each of those crises and the impact on either markets and or the economy, very different. Where does this all go? So we love illusion when we're, watching a magic act.
Right.
But illusion is inherently predatory. And so I'm fearful that if people now see that they've been duped, then that raises a broader question of by whom. And it's one thing to think that they've been duped by, startup companies where, you've got very aggressive entrepreneurs, touting the future. But I think that there is a sense that, hey, I've been duped too many times. I was duped with the dot-com bubble. I've been duped with a housing bubble. And I think there's a real likelihood that the crowd says that they're angry about this, that they want something done. You know, how could this happen again? And that's why I use the term scrutiny, because I think people are going to feel like they've been really, really abused in this.
So who do you blame in this process? Is it regulatory, lack of oversight, or is it, you know, money moves quickly. You know this through the financial system, and the financial system, markets in particular, are always looking for, I'm not going to say how to game the system, but for that new opportunity, you know, and sometimes all of the transparency about some new opportunity, it hasn't yet been revealed.
And I think that, yeah, there will be questions as to who to blame. And sadly, Carol, the list will be long because when confidence is high, scrutiny is low. We don't pay attention. We don't regulate as much as we might otherwise. There's a whole social phenomenon. And with this one, especially great because it's become almost cultural, because we have this entire universe of influencers on social media who are in some ways portraying themselves in a masquerade as well.
Do you think that's all dangerous, the retail investor crowd?
I think that retail inevitably shows up late. That's what all of the research shows. They are drawn into it after an enormous amount of money has been made, and then they get very aggressive very quickly. And so I watch meme stocks as a sort of a parallel to other market peaks, and I think that it should be more cautionary than exciting to the retail investor.
It's interesting. We have 30 seconds, then we'll come back and talk more. But I do wonder, too, Peter, that we see institutional money, I feel like, following the retail Reddit crowd, and I wonder what that tells you as well. I feel like it used to be reverse of like retail following what investors have been doing or institutional for a long time, but it's going in the other direction.
Yeah, and so you have a lot of institutional investors who, whether through AI or through algorithms, are automatically trading into this. So it just draws them in as well.
All right, Peter, sit tight. We're going to come back to you. Peter Atwater, he's adjunct professor of economics over at William & Mary. He's joining us on the phone from Pennsylvania. We'll continue the conversation. He's looking at the markets, tying it all together. We're also going to get an update on what he thinks about where we are when it comes to the K-shaped recovery and what maybe that Fed decision meant last week. You're listening to Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. We're going to get back to Peter Atwater. He's adjunct professor of economics at William & Mary, joining us on the phone from Pennsylvania. So we'll get back to him in just a moment. I want to ask him, he talks about concerns about kind of the next bubble, if you will, coming undone, impact on the markets, and why he says it could be more than just a pause or pullback. So we'll talk a little bit more about that. In the meantime, back to Doug Krisner with some of the news after the close. Hey, Doug.
Hey, Carol. Yeah, let's look at what happened in the equity market today. It seemed as though the reopening trade was in high gear. We had St. Louis Fed Bank President Jim Bullard saying the American economy is booming right now, and it's on path to recover more than what it lost during the pandemic. So we have energy, financial, and industrial shares leading the S&P 500 higher by 1.4% on the day. The Dow was up 1.8%. The NASDAQ composite meantime ahead by 0.8%. Boy, there was a lot of weakness in Bitcoin today, down at one point by more than 10%. Right now we're trading 32,650. Overnight, Beijing ordered the Chinese payment platform Alipay and some domestic banks in China not to provide services linked in any way to trading of virtual currencies. And the ripple effect was seen in price action, or in the price action of NVIDIA shares today. The stock was down because this company really gets a lot of its revenue from those graphics cards that are used in crypto mining. Shares in ExxonMobil rallied today. A lot of energy stocks were up in sympathy with the price of crude oil, yes, and crude in New York was up more than 2.5%. But ExxonMobil is also preparing to reduce headcount at its U.S. offices by between 5 to 10% annually for between the next 3 to 5 years. We are told the company will use its performance evaluation system to identify low performers. I'm Doug Krisner. That's your Bloomberg Business Flash.
Very interesting. All right, Doug Krisner, thank you so much. Still with us is Peter Atwater. He's adjunct professor of economics at William & Mary. He is with us on the phone from Pennsylvania. Peter, before we move on a little bit, I do want to just continue with your writing about the coming age of scrutiny and how you talk specifically about what ahead will be a third major betrayal in 20 years, and that specifically it would be more than just a pause or a pullback. So what do you think investors, or how do you see it that investors, what they should be preparing themselves for?
I think investors need to be prepared for far greater reevaluation of risk, both in the credit markets and especially in the equity market. When Archegos failed, the question was what would happen next. And you're starting to see at Credit Suisse, it's pulling back, it's lending to other similar entrepreneurs and big investors. And I think that sea change is likely to continue. And so investors who have taken great advantage of ample liquidity and rising markets should be prepared for a reversal of trends both on the equity and credit side.
Does it happen when the Fed starts to unwind?
I think it happens almost independent of the Fed.
Okay.
I think that we attribute far too much power to the Fed, and in many ways, as policymakers, they react to the behavior of the crowd. And so I look at Fed action last week, for example, as really a lagging indicator of where the crowd has moved, and their attempt to keep up with that.
Well, and I love that you said that, because I feel like some of the observations post-Fed meeting is just and I agree with it, that the Fed was finally acknowledging some of the concerns that were out there, and by starting to talk about it.
Yeah, I think they had to, and I think the contrast in response was significant versus what we saw earlier this spring. In March, Powell was all but received a standing ovation from the press conference, and this response suggests that policymakers are still not in sync with where the sentiment of the crowd has moved.
Having said that, policy isn't something that they're just going to kind of all of a sudden rip or pull a ripcord, because that's just not how the Fed does it, whether it's the Powell Fed or whether it was the Bernanke Fed or maybe more likely the Janet Yellen Fed. I mean, they have gotten very good about indicating what's to come. Yeah, they recognize that narrative is far more important than the specific fact of the action. And so they're very careful and deliberately and I think rightfully so in what they say. The challenge is aligning it today with narratives that are moving all over the place, because one day you have lumber up and the next day you have lumber down. Exactly. And we do it. We talk about it like it's a big change, but it kind of goes back and forth. Having said that, one of the narratives, Peter, of the Fed when it comes to the labor market coming back, and we still know that there's millions of jobs that need to be to come back before we get to those pre-pandemic levels. But the Fed has talked about, too, about inclusion and making sure that when the jobs come back, it hits minorities as well, that they also see jobs coming back. Do you think the Fed will be able to hold out if we start to see the labor market improve, generally speaking, the headline numbers, but we don't see the improvement maybe among some of the minority communities? I think that, well, I never expected the Fed to respond to the K-shaped recovery the way it did when I started talking about it. Okay. But it is clear that mandate is important to them. And I think it speaks to just how extreme the divide had become. And so I do think, and again, in that swinging of the pendulum, that there is a far greater focus on the plight of those at the bottom, recognizing that from a monetary and fiscal policy perspective, may need to be more sacrifice from those at the top. And you think the Fed gets it and that they will hold out? Because there is some concern, about the Fed. We know what their dual mandate is, right? But if they start to see inflation concerns and if those job gains aren't there among, Black communities, Latin American communities, the less served communities, whether or not the Fed will continue to consider that to be a really important metric for them to meet. Yeah, and I think it puts them under the gun socially in terms of scrutiny of their own mission. And so I think they have to be very careful here not to lose sight of the hope that has been put in them by those at the bottom. Right, because it's certainly carrying an awful lot of weight. Peter, thank you so much. Always thoughtful and always keeps me on track by shooting me little messages and research to check out, because it really takes us to places that we need to be having discussions about. Peter Atwater, he's adjunct professor of economics at William & Mary, on the phone from Pennsylvania. Just a quick recap of how we ended on this Monday, pretty much finishing at our highs of the session when it comes to the equity trade, up 586 points, up 1.7% on the Dow Jones Industrial Average, 33,876. S&P up 1.4%, and the NASDAQ a gain of 0.8%. All right, now for a check on world and national news, over to our 99.1 newsroom in the nation's capital, and Nancy Lyons. Hey, Nance.
Hey, Carol. President Biden is still not buying into a draft bipartisan Senate infrastructure plan. A group of 21 senators, including moderate Democrat Joe Manchin, as well as Democrat Kyrsten Sinema, are behind the draft proposal. But Bloomberg Government's Emily Wilkins says one big question remains: how to pay for it.
They've agreed to a top-line number. They've agreed on spending, this bipartisan group of senators. But they've been talking about paying with this with a gas tax. And President Biden has said, absolutely not. We're not doing that. We're not doing fees on electric vehicles. The White House has put forward some other ideas on how to potentially pay for it. But that really needs to be agreed upon before either side can say, we're good on this one.
Aides say President Biden will host lawmakers this week to discuss the plans. The president met this afternoon with financial regulators to discuss things like climate change and inclusion. A test vote is scheduled tomorrow on a sweeping voting rights bill. Senate Republican leader Mitch McConnell says the bill would trample on states' rights.
The real driving force behind S1 is a desire to rig the rules of American elections permanently in Democrats' favor. That's why the Senate will give this disastrous proposal no quarter.
The measure needs 60 votes to move forward, and that is an unlikely outcome in the tightly divided Senate. Facebook is launching podcasts and live audio streams in the U.S. to compete with its rivals. Facebook says it will allow public figures with verified accounts to start live audio rooms and invite anyone else to speak. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts to more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. You're listening to Bloomberg Business Week. Carol Masser in our Interactive Broker studio. And joining me right now is Doug Krisner, host of Bloomberg Daybreak Asia. This story, Doug, just sent it around. It is among the most read on the Bloomberg terminal.
Tell me why, do you think?
I don't, because you put Bumble in a headline and people are like, yeah, it's a Monday. I'm going to check this out. Either because I was on the app over the weekend or I wasn't on the app or just because it's Monday and I need something else to read.
Well, the company is temporarily closing its offices this week to give employees, about 700 of them, right, a much-needed break. They're calling it kind of recover from COVID burnout. And I didn't realize until I read some of what this story was reporting that it's a wider issue, right? Citigroup announced earlier that it was banning Zoom calls because it was concerned about burnout.
Don't you really want to know about why these folks are so burned out? Was it just people were, stampeding the app and using it constantly during the shutdown?
Yeah, maybe that's, but I think everybody had to learn, right, very quickly.
Yeah.
The pivot away from the office to the work from home environment. If you weren't technologically savvy before, you really had to come up to speed very, very quickly, and that may have contributed to some stress.
I know, I'm laughing about it, and I shouldn't because it's real. And we've had multiple conversations with CEOs at companies that it wasn't just physical stress and worry about your health during the pandemic, but it was mental stress between your responsibilities at home, whether it was taking care of elderly, taking care of kids, schooling kids, but it was also, being isolated for many individuals, and just, you're right, Zoom after Zoom after Zoom call, and the toll that took on everybody.
So this is going to be part of the conversation as we continue to move back to working in the office, and for the companies that are trying to create a hybrid situation, work from home, work from the office a little bit. I mean, this is going to be very much, I think, part of the conversation.
Yeah, and I don't think we've quite figured it out. Most people will say we can't go back to what was the normal because we've lived through a pandemic and it's impacted us, and we can see what we can do working from home. But how it ultimately is, brought into how we work going forward, time will have to tell on that one. All right, Doug, thank you. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
In the equity market today, it was all about the reopening trade. We heard from St. Louis Fed Bank President Jim Bullard today. He was saying the American economy is booming and it's on a path to recover more than it lost in the pandemic. Not a big surprise that we had a move up in long-term interest rates. 10-year Treasury last quoted in New York at 1.49%. And in the broader market today, insofar as the equity trade was concerned, we had strength in energy, financials, industrial, and material shares. Crude oil right now at 73.55 in the electronic session, so we're up about 2.7%. Tomorrow, Fed Chair Jay Powell is set to testify to the House Select Subcommittee on the coronavirus. Now, in prepared remarks that we are seeing now, Powell will say inflation had picked up, but it should move back toward the Fed's 2% target once supply imbalance is resolved. Now, he has said this pretty much before. He cited increases that we have seen not only in oil prices, but in a rebound that we have seen more broadly in U.S. consumer spending. And he called these effects transitory, and he expects inflation to drop back toward the Fed's longer run goal. But nonetheless, we are up in terms of the rate environment. 10-year Treasury just, let's call it 149. Dow Industrial Average higher by 1.8%, S&P up 1.4% today. NASDAQ Composite ahead by 0.8%. I'm Doug Prisner. That's your Bloomberg Business Flash.
All right, got it, Doug. Thank you so much. So India, home to more than 1 billion people, an emerging and developing economy that has been on the front lines of the coronavirus health pandemic. The V-shaped economic recovery that India's policymakers obsessed over last year did eventually materialize, but this year it is a different story. Here with the front seat and firsthand view of India is Her Royal Princess Janhavi Kumari of Mewar. She joins us on the phone from Jodhpur City, India. Your Royal Highness, thank you so much for joining us here on Bloomberg. How are you?
I'm very well, thank you, Carol, and thank you for having me.
It's nice to have you here. I want to talk about a few things, but first of all, India, a large country we know. How is it doing with the pandemic? I was looking at some numbers, 277 million doses given in India. That's about 10.1% of the population. What are you seeing firsthand?
So, Carol, India has, of course, experienced an unprecedented crisis, very much like the whole world has. I think the problem that India has faced in the past 15 months is that our policy making by the government has lacked some level of sophistication and execution of it. And if we were to talk about the responsibilities that lie with the leaders of this nation, I would have to look at it from a balanced perspective. I think India has been suffering from a significant absence of investment, or let's call it underinvestment, in the public healthcare sector, which of course has amplified the issues that India is facing today. It's been a death-dealing crisis. There's been a lack of proactiveness on the government's part when there was the opportunity to do so in the early and comprehensive lockdown that we had last year. But unfortunately, the problems have just been compounded by the fact that our public healthcare infrastructure just wasn't ready for it. Our legislative system just wasn't ready for it. Our legislations go back to the colonial era, and there's no modifications to them. So to adapt to a crisis of this level has obviously proven exceptionally challenging for us.
Well, Princess Kumar, I guess at this point, do you think that things are better post-pandemic, that the government learned something about the policies that need to be in place? Or do you think that once we get on the other side of this, for India, we kind of just move on with getting back to things as they were?
So, Carol, my view is not so much purely India-centric. It's more global. I think what we need moving forward is first and foremost that we absolutely must not let the wisdom of experience be wasted on us. We've got to find a way to work together. It has to be a collective action to solve this global, not only the global pandemic, but the problems that the world is facing post-pandemic. So if I was to break it down, I would say politically we need better global governance. We need collective action. We need a new global coalition. We need a new form of internationalism, or let's call it an all internationalism, because what we have today is internationalism that is completely outmoded for the needs of the present day and the future. What I've also
well, do you think? Well, if I may follow, Princess Kumari, do you feel that the developed world has really failed the developing world, especially when it comes to the health crisis?
I wouldn't say it's been an entire failure. I mean, if you look at how the U.S. and India have collaborated during the course of this crisis, I mean, the Biden administration, supported the intellectual property waiver at the WTO. It's come to India's aid with medical resources, raw materials, and at this time of need with vaccination. So I wouldn't say it's been an entire failure. I would definitely say that that's just two nations acting together. What we need is collective action. What we need is countries and nation states working together to promote and regulate proper global governance and also facilitate some accountability at large, because at the end of it all, what we've seen is a crisis of collective action. There's no sectional response to a global problem, and that also extends to the financial world and the global supply chains and how they're currently structured. How there's a clear case of weaponization of interdependence, which needs to be addressed.
Well, and it's interesting because what we're seeing is some pushback to some extent of a couple of arguments. Some saying the global supply chain is here to stay. There's no way to undo it. But at the same time, you did see those nationalistic forces certainly kick into high gear during the pandemic, and companies and leaders rethinking, wait a minute, should I have my supply chains also closer to home?
So, Carol, you're absolutely right. I think, as I was about to say earlier, these fault lines have been observed and they are being addressed. But are they being addressed in an effective fashion is my question today. Mm-hmm. Because the global supply chain, of course, isn't going to go anywhere. It is what we are seeing is a significantly integrated global economic infrastructure that cannot be undone anymore. But what we can do moving forward is re-engineer and restructure these global supply chains with the objective of an incentivized engagement that promotes shared values. It facilitates more accountability. It weans us off, deviant-natured states. It allows us to create a new economic infrastructure, a more effective economic infrastructure that is not holding hostage other nations, other democratic nations.
Princess Kumar, we have to leave it there. I hope we can continue our conversation in the future, because I find India, certainly as an emerging economy, fascinating, and I do know it's a difficult time right now, but looking forward to talking with you again in the future. Her Royal Princess Jahnavi Kumari of Mewar joining us on the phone from Jodhpur City, India. Coming up, Joe Matthew with Sound On. Joe, what's on tap?
Just got a readout from President Biden's big meeting with the lead financial regulators, including Janet Yellen, Jay Powell meeting with Joe Biden today. So we'll be talking about that coming up as we get in advance on what Jay Powell is going to tell Congress tomorrow about inflation.
To be a fly on the wall on that meeting, huh?
You better believe it. We're going to get one, too. Josh Wingrove will be here.
He's our fly on the wall.
That's right.
All right, good stuff. Joe Matthew coming your way at 5 p.m. Wall Street time with Sound On, all the news out of the nation's capital. That's going to do it for the Monday edition of Bloomberg Business Week. For Tim Stenovic and the whole Bloomberg Business Week team, have a good and safe evening, folks. We'll see you tomorrow. Sound On is up next.
Okay, traders, as you can see, I still hold short position on Swiss franc. I will keep it overnight. At the end of the day, it's free for me, and broker pays me for holding overnight short position. The only difference will be I will move to sell if some changes happened to, let's see, to 0.91876. Oh, sorry, 871. Okay. So this is where I move, and I probably will even move lower to 0.91821. It will give me, if it will close at this level, it will give me £2,000 in profit. Okay, guys? So you can sell if you want right now these holdings. If you don't want to hold overnight, it's your choice. I will hold until tomorrow. I will not put guaranteed stop. It will stop when the price will reach the level 0.91821. Okay? And I'll speak to you later, guys, and have a nice evening.